Well, let me explain something about myself, because I'm sure Eric's about to do that. I've stolen his introduction already. I know he's fine introducing. Do you want me to introduce myself?
Just carry on. You're already there. So.
Yeah. Well, let me just say something about myself very quickly. I am Ed Matts, Matrix Trade. It was set up 20 months ago. I have been a lifelong trader. My mother had the misfortune, or I had the misfortune, of being introduced to markets when I was 8. And I went forward, I followed stocks, I won't go into the details of why. Went to university, studied PPE at Oxford, came out as an economist, went into the city, thought I knew better than everyone else, and lost a packing. And then soon learned that there's no good being right in the wrong market. And actually something that moves markets isn't necessarily the economics I learned at Oxford, but something totally different. I then had the privilege, the fortune, and some great tales which I'm not going to share with you today, but also the education of working with some of the best traders out there who have now retired, and some of them still going. And one thing we wanted to do at Matrix Trade is try to quantify some of those tricks, some of those things those experienced people did. In other words, provide a shortcut to experience, not just for ourselves, but some of our many clients worldwide, institutional clients as well. So today's talk is clarity before a crash, and I apologize right up front because we are in the tallest building in London, in Britain in fact, and so it's a bit unkind to start with. Oops. Can I close this? It's supposed to be an earthquake. I tell you what, can you all stamp up and down and pretend we're having an earthquake? Because that's one thing, two things I want to talk to you today. The first thing is earthquakes. And the second thing is potential, because the other day we saw in a 13.6% drop in the S&P in 6 days. That, for many people, and suddenly, all the Armageddon, the doom and gloom artists have sprung up and said, we're heading for a crash. So the story that many people have told for the last 6-7 years about, we're heading for a crash, and suddenly being resurrected. So what I want to do today is talk to you a bit about us, explain where we come from. We are earth-shattering, even though the earthquake didn't play. It's essentially a relatively innovative macro approach to markets. We cover foreign exchange, a lifelong foreign exchange trader. That's how I started at Citibank. In fact, I was the first technical trader at Citibank ever. Shows you how old I am. Stock indices is something we specialize in, particularly the S&P and the German DAX, stocks, individual stocks, and commodities. And because the SEC describes Bitcoin as a commodity, we group that under commodities as well. But what we're about, and what I'm about today, is evidence-based trading and analysis. Now, I'm sure many of you are successful traders. I'm sure many of you have other roles in life and you're successful there. And one thing you would not do when you're undertaking a project, when you're about to make an investment, you don't just dive in. You do your homework, don't you? You look for the evidence before you jump in. Well, it's amazing because finance is arguably the fattest industry in the world. And yet so many people advise you, so many people dive in and invest money without doing their homework, without doing the evidence. So if there's one word you want to lead today, my talk today, evidence. Before you do anything, evidence it. And that's essentially what I'm going to provide today. Are we heading for another earthquake or a crash? The answer simply is yes. Now, the reason why, and it's not an original thing, you've heard it for over the last 6-7 years, is that we're repeating the same drivers of 1929, 1987. Now, there are a lot of people who have said that many times before, and they've been proven wrong. The difference is that we have been bullish all the way through, using the same drivers until very recently. And the simple reason is since 2009, the markets have been, and I'll show you in a minute, have been repeating the same patterns, the fundamental intermarket technical sentiment patterns that we saw, well, not we saw, because most of us weren't around in 1929, but I certainly saw in 1987. So today I'll be going through the drivers, what that amounts to and what that means for today and for the next few months or weeks, but also the evidence. Now, there is a huge amount of evidence. In my 30 years of trading, I have never seen such an overwhelming body of evidence pointing to one thing. Now, because I'm going to hit you with so much evidence, you will be able to download it or find it on matrixtrade.com.xtb. So if you want to make it, rather than take photographs or try and do a drawing of a chart or whatever, if you go to that URL, you'll be able to pick it all up. So if I were to ask you what really drives markets, I'd probably get 100 different answers. And you'd all be right. Because at different times, different markets are moved for different reasons. You know full well that when you buy on a technical factor, but some news comes out and blows your chart away, you know it's the fundamentals. So what you need to do, what we do at Matrix, is we look for what's driving the market, look for the evidence, look for the proof. And by knowing that, we can actually see what will happen next. And the best way of determining what will happen next is what the market has done in a similar position, faced with the similar drivers, faced with the similar traders, what it will do next. And that comes from history, evidence-based analysis. And one of the best proofs of history is you hear so many deductive arguments saying X, Y, and Z will happen because of X, A, B, C. But is the price action mirroring your drivers? In other words, your fundamental drivers that aren't on the chart, or the sentiment drivers? Is the price action similar to the similar conditions? And if it is, and you know there's a reasonable chance, it might, not necessarily, but it might continue. So I started off today by asking who you are, and if we are facing another earthquake, another crash, who you want to be. This is Paul Tudor Jones, who made his name and fortune in 1987's crash, and I'm sure many of you know of Nick Leeson. And if I'm talking about a crash, or in fact talking about an earthquake, then both of them also featured very strongly in the Japanese earthquake back in 2011. So, we have an earthquake. It's dollar yen. In Japan, unfortunately, and apologies for the example, but it serves a purpose. What would you do? Dollar yen, there's an earthquake. Well, you buy dollar yen, yeah? You sell yen because that's going to be bad for the country, bad for the economy. So let's buy. Oh, no. In all three cases, the market went down. We're wrong, we're losing money. And in fact, Nick Leeson literally did lose his bearings. That was a liquidation of the bearings, not just stock, but dollar yen portfolio. So let's double up, yeah? It's at the bottom of the chart. We know it can only go one way. It goes back up. What happened, the reason it went down, was because the first move was actually a repatriation of yen. So while people thought the yen should weaken, it actually strengthened because real money went through. And also there were a lot of weak longs thinking it should go up, so it was taken out. And then you started to see the real fundamental drivers coming in, knowing that the Japanese government was going to have to spend a huge amount of reconstruction money. Market sentiment was bullish, the retail market was bullish, and they started making lots of money. It got rallied very strongly. And that's when things started going wrong for many people. The retail market started suddenly thinking that enough is enough. And yet the funds, Paul Tudor Jones, was buying still. And that's what happened. The market started going higher, but in all three cases, I don't know about 1923 to be honest, but in the last two cases, you saw the Nikkei go up, you saw JGBs moving, the whole market was moving in sync. It was a fundamentally driven move. This is what's happened after three earthquakes. It's amazing, the similarity of what's happened. And you ask yourself why. Well, and then what do you think is going to happen now? We've got a bit of a head and shoulders. There was a head and shoulders there, you can't see it. There's a head and shoulders there. Whack. And we're getting closer to today. The same things happened, the reversal. What happened in the last stages is that the market started breaking down. The Nikkei didn't go up with it. The funds started getting out. Retail kept on buying, but the funds, like Paul Tudor Jones, got out and said, thank you very much. And this is where we are today. You want to see what happens next? What happened in 1923 and what happened thereafter? That, if it continues to play out, and it may not, that's what it did. It continued lower. Why though? Well, the simple reason is because what drives markets, when people are confronted with the similar conditions, the same fundamentals, the same intermarkets, the same technical, same sentiment, it does the same thing. So what really moves markets? Whatever fits. The fundamentals, that's the real world. In other words, what the Japanese government was doing in response to the earthquake. The intermarket relationships, the Japanese government bonds, stocks, and dollar yen all moved together. They were cohesive until the final stage when they stopped going with each other. The technicals, we saw a very well-defined uptrend that ended in the head and shoulders. Head and shoulders are great trend reversals in the right market at the right time. and sentiment. You saw the retail started fading against the real flows, the money that was going to stay out and hold it. And also the robots. Since 2008, the market has changed to the extent that the HFTs and algos are significantly larger volumes. But they are programmed to do the same thing, confronted by the same conditions, obviously. And a lot of the analysis that builds up to those trading models is actually based on human sentiment-driven markets, what it's done previously. So they're necessarily programmed to repeat themselves. So what we do, we try to find the right indicator at the right time. And the best way of measuring that is performance and price. And the best way through price action is what it's done before by comparing it in similar conditions. And the best evidence then is what it did before. Because we all tend to do the same thing, whether we're a Japanese trader or an American trader or slightly hungover on a Saturday morning and in Canary Wharf. When confronted by the same evidence, the same conditions, we tend to do the same thing. Because ultimately, it is sentiment. The people who make the decisions about buying and selling, confronted by the same conditions, have the same types of sentiment, given the same risk profiles, the same desire to make money or not lose money. Markets also will relate, the four asset groups will relate the fundamentals. So the fits, not only by sifting through the drivers, sifting through the evidence, if you do that and then you use history to identify similar conditions, what might happen, like it happened before, you shift the odds in your favor. Now, as Confucius said, if you study the past, you can divine the future. And what I'm about to go through now is a body of evidence. What happened before may well happen again. And what is the evidence? The fundamentals: economic growth, GDP, inflation yields, and central bank policy. I'll just show you, try to be quick with this, some of the things we do as a matter of course. This is a unique market. This is a very unusual market. The last 2 years, we have seen a series of earthquakes, high volatility. Recently, we've seen hyper volatility. That's not usual. But in the normal course of events, markets have a habit of repeating themselves. Let me show you economic growth. This is some of the things we look at. Is that in the 5 days before and after an economic release, the market, it is being driven by expectations about NFP. Gold is remarkably consistent what it does. You can see what it should do on the average and how it tracked it. The same with the euro-dollar on GDP as well. Obviously, they're going to be similar. In foreign exchange, one of the major drivers in a normal market is the interest rate differential. And you can see this is for the last year, how dollar Canada has hugged its interest rate differential. You notice how the differential is leading it down. And it's a really cool device, and whoops, something's going wrong. The next slide is one of the most important slides of this year. Dollar yen. Anyone who's been trading dollar yen, trying to base it on correlations, base it on the Nikkei, base it on the 10-year yield, or whether it's JGBs, or in fact the US will know that it's done something very, very unusual and very weird. Remember this slide, because I'll finish with it. In the longer term, central bank policy does drive foreign exchange, but not necessarily the way you would expect. When they first raised rates in the United States, this is the 4 last tightening cycles. You can see that dollar yen should go up, shouldn't it, if they raised rates? No. In all 4 cases, it went down and followed a very similar pattern in each case. In the shorter term, the market also tends to move in a consistent way before and after central bank meetings, unless they do something really sensational like, say, Draghi and Sintra, or one or two of the Carney speeches when he tries to undo the damage he's done previously. Markets interact in a consistent way as well, because it reflects the underlying real world. Whether it's the price of oil goes down, you start seeing people close shop, the frackers start closing up business, and that necessarily restricts supply, so it goes back up. But that also, because the price movement has an impact on the real world, it comes back into the price, because the oil price goes back up. Now that's great, and that's obvious, and that's not necessarily helpful to know that, unless you just keep an eye on what's going on, you understand it better. But in fact, what people don't realize is the flow of money. when you make a decision about a market, you may decide right here and now and react right here and now, but in fact you may be looking to do something in a week's time or a month's time or maybe even 6 months, a year's time, based on the same conditions and criteria. Which is why a lot of people following correlations come unstuck, because they expect the correlation to be instantaneous, but it isn't, not always. You can see a staggered flow from a day. Quite often you see one market that's correlated to another, move 24 hours later, and it appears they're not correlated anymore, but they are, it's just delayed. So let me show you some of the things we've been looking at, or look at. This is gold, going back to the beginning of 2016, when gold was moving down, following a very similar pattern to the first time they raised rates in 1998. Gold was doing something identical to the first time they raised rates in 2015. And what triggered this move was the Washington Gold Agreement, when Gordon Brown sold the UK gold reserves, and everyone else was worried that the other central banks might do the same, and so they agreed not to sell in their gold, and gold went through the roof. And lo and behold, gold did exactly the same thing, followed the same pattern. They gave us a template called the Washington Gold template. Yes, and lo and behold, 72 days later, oil, same asset class, did exactly the same thing, and has followed pretty much the same pattern since. So the same, that makes sense, because you know oil, gold, commodities, yields, world economy, they're going to be related. Well, let's try a different asset class. Let's try the dollar, the euro dollar. In 2016, 272 days later, the euro did exactly the same thing that gold had done, not just 270 days previous, but the same thing that gold did back in 1999, because the conditions were similar. People reacted in a similar way. And the same thing with technical analysis. The basis of technical analysis is you find a pattern and you trade it because you know it's done the similar type of thing before, whether it's a trend line, head and shoulders, or whatever. That is the premise on which we operate using technical analysis. So those patterns should perform. They're probability patterns because sometimes they don't always move the right way. And also with certain instruments or indicators like RSI is a great range, and anyone who's tried to use an RSI in the US stock market in the last 2 years is no longer using it, for the simple reason that it's been in trend, where moving averages perform much better. Using the right indicators in the right place. Now, one question I would ask you today is, do you know your market? Do you know which indicators work best for the instruments you trade for that particular time? Do you know about what type of targets, what retracements it likes? For example, trade dollar yen. Dollar yen, when it's in trend, likes to trade correct very shallowly, 23.6%. If you trade cable, you probably know full well. If you bought against the bottom, you know it likes to retrace 95%. That's how it trades. So do you know your instrument? Evidence-based analysis. Eurodollar, talking about head and shoulders. Trade Eurodollar. How many people here trade Eurodollar? You trade head and shoulders on them? Don't. Or in fact do. Because 73% of Eurodollar head and shoulders are bought. Which means, because they tend to go 75% of the way to its target once it's triggered to the neckline, it is actually a great trade the other way. In other words, wait for it to go 75%. You have a 73% probability of making money by going for an abortion of the head and shoulders. Note actually something, this is really cool. This is when the euro started. This is a synthetic euro, it's dollar mark. Notice the similarity. Notice the two head and shoulders. And if it's aborted, this is what it did last time with the head and shoulders. Why would it do that? Sentiment analysis. Okay, if we strip out all the fundamentals, strip out everything else. If markets move on sentiment and people tend to do the same thing, then surely, if you can take everything out and just look for a sentiment-driven event, then if people repeat themselves, then the price action repeats itself. You tell me an event like that. Well, a holiday, yeah? There's no reason why holidays should have any particular importance. So if what I'm saying is right, then markets should move the same way in and out of holidays. How many people have heard of Jesse Livermore? Basically said that the reason why markets move the same way is because people don't change. Benoit Mandelbrot, ever heard of him? Any physicists in the audience? said the same thing. Markets have a habit of repeating themselves in the same way. Well, you know, there's a couple of guys, a couple of people who are interested in markets, you know, there's millions of people out there. But when confronted by the subprime crash in 2008 to 9, the Bank of England commissioned a study of what caused it, what markets do, and they came to the same conclusion. They said that markets exhibit fractal properties. In other words, they may seem complex, but they will repeat themselves in a similar structure over and over again. So let's have a look at that holiday. This is the S&P, what it did on Martin Luther King Day, what it has done previously and what it did this year. This is dollar yen after the last holiday, George Washington's birthday. I haven't updated it, but you know what dollar yen, if you trade dollar yen, you know it's done that. It's amazing. Why? I mean, I wouldn't believe this stuff if I didn't actually see it day after day. That's what it does. And as Winston Churchill said, the longer you can look back, the further you can look forward. So let's look back. This is some type of thing we produce. It's one of our analysis pages. We look at markets 3 months down, well, 1 year ahead, even more, down 3 months, and we present that analysis with charts and the evidence. You can see the amount of evidence. This is DAX, 48 hours, 8 hours. But does it work? Well, we've made, on average, since we've been going 20 months, we've made on average 10% a month. And that's our performance. So certainly, given the markets we've seen, the markets have been repeating themselves. Our technology and what we do has been working. So that's enough about us. Are there any other earthquakes out there? Well, one reason we were successful last year is because we had this template. Eurodollar did a typical pattern in and out of the Greek referendum. Sterling, dollar sterling, did exactly the same thing into the Brexit referendum. Now, I got Brexit wrong, and yet I had this template and made money. Why did I get it wrong? Because it told me that sterling would go to 150, then come off. So I assumed that meant we were going to vote to remain and then buy the rumor, buy the fact. Whoops, and off it goes back down. But in fact, it relived the same pattern that the Eurodollar did after Brexit. So in that vein, is there anything else out there that could tell us perhaps about the Eurodollar? Any big events? Italian election? I'm going to show you what the Eurodollar is doing and what it has done previously after the Italian election on March the 14th. Similar? As to whether it pans out, I'm haven't been looking for a move that strong to the downside, but I'm certainly looking for a retracement from another new high. So that's something to keep an eye on. As to why it might do that remains to be seen. It could be the same as Brexit. I can get the market right, but for the wrong reasons. Again, any of these slides you can find by following the URL. The earthquake of this year, out of America, the Trump bubble. I'm sure some of you, in fact, I'm deaf. If you've seen many presentations on Bitcoin, you will know people talking about the bubble and the Rodrigue model. And yes, the Dow Jones has been following it. Yeah, but you've seen someone do this, I'm sure, probably over the last 5 or 6 years. I could squash this chart and put it there, and then I could tell you it's going through the moon. It's easy to fit around and play with a chart to make it look like something similar, but not if you have the right drivers in the right place. 2018 fits the fundamentals, intermarket, technical sentiment, fits with 1929 and 1987, and I'll show you why. Does that look similar? Yes? No? It looks similar, doesn't it? Can you see what it did? I don't know if the white comes out. Where? That wipes out the Trump gain. It's kind of an eloquent solution whether you're a fan of Donald Trump or not. The reason why that may happen, let's start with a premise, shall we? Let's be skeptical. The reason why that may happen, I don't know if you've heard of John Templeton. He was one of the biggest contrarians out there. He's one of the most successful traders ever. God bless him because he's now dead. But he is a brilliant quote. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So on that basis, the market's been euphoric. Has it been euphoric? feels like it. So let's take what has happened as a template. Certainly in 2009, the market was pessimistic, and so it started to rally against that pessimism. It was born on pessimism, if you like. With the quantitative easing out of the US central bank, thank you, Ben Bernanke, and I'm sure Janet Yellen is very fond of him as a consequence, the market started to rally. And this is the fundamental, this is the movement of the fundamental driver, was the middle part up to around 2016, early 2016, and thereafter, sentiment started taking an increasing role. The reason I say sentiment, because although Donald Trump has rocketed the US markets higher, it's been on expectation rather than actual delivery. Growth is still around 3%, inflation is still traveling lower, he's yet to deliver, but we all believe, given his tax cuts and everything else, he probably will deliver, or will he? The same fundamentals. Are the fundamentals the same? 1929? Not that I was there, I'm sure you've all seen films about the period and Shoeshine Boys and everything else. The fundamental conditions for a crash are identical to 1929 and 1987. You saw an exorbitant rise in stocks in both cases, obviously, otherwise we wouldn't be talking about it. But it was yet led, in all three cases, and this is one of the matrix theories, it's been led by universalization of prior invention. What that means is, in the 1920s, the reason the stock markets went higher, led by the likes of Radio Corporation of America, was because of the inventions in 1905. And it's only in the 1920s did they mass produce them, that the economy took off as a consequence, because everyone's buying fridges and televisions, and well, probably not televisions, but radios, and the consequence, and because it was mass produced, inflation didn't go higher either. Prices came down. In the 1980s, the same thing happened with computers. Computers had been around previously, but it's only in the 1980s that you saw a mass production of computers, and they started off expensive, but prices. A lot of money was made by the likes of Intel. Stock markets started going through the roof, yet inflation didn't shoot. People expected inflation to go higher, but it didn't because of the mass production that kept prices, certainly computers, down. And the same thing in the 2010s with Web 2.0, with the explosion of the internet. Well, the internet's been around for years, but not to the extent that it's all... How many people here do not have a mobile phone on them? Oh, congratulations, sir. I sympathise entirely. The explosion has been in social media, and that's not just an explosion now, because I'm arguing in favour of a crash here, but one of the things about a post-crash environment is the developing country. What the internet, what social media is doing is creating the framework for the next bubble, the emerging world, the emerging markets. And that will be where the opportunities will lie thereafter. The same conditions. And yet, through the likes, I keep putting that on, through the likes of Amazon, Janet Yellen says inflation's a mystery. It's lower than it should be. Why is that? Because internet downward pressure, internet sales is putting downward pressure on prices, so inflation isn't going higher, even though the likes of Amazon are raking in the profits. It's exactly the same scenario as 1920s, 1980s. And at the same time, US government deficit is increasing. Why is it increasing? Well, we've got promises from Donald Trump of huge infrastructure plans, and unless he gives the money to Amazon, that should put up inflation. No, it should improve growth, yeah? But at the same time, it's running a huge increasing government deficit. The same thing happened. In the 1920s, you had the Mellon cuts, Ronald Reagan. If you look at a chart of when Ronald Reagan started cutting taxes, it's very similar to the timing on the chart as we're going through now as Donald Trump's tax cuts. And at the same time, we had an increasing trade deficit. You cannot have those three conditions together at the same time. It puts too much stress on the economy. Yeah, I could be here in a year's time saying the same thing. I could be saying it for the next 5 years, but ultimately it'll prove right. But that's no good to a trader. But ultimately, you cannot have those three pressures. Expectations, and therefore stocks higher, and a drain on the economy through the trade deficit, and increasing burden and risk through government deficit. And as a result, obviously, we have the same as the 1920s and the 1980s, and what, say, Ronald Reagan did about the Chinese and computers. We have the same cause for protectionism. And And the charts, they don't have to be similar, but the US trade balance is pretty similar. And although the government, in fact, in the 1980s, it came from a surplus, we have the same pickup in the government deficit. So they're similar, yeah. It's kind of interesting. But let's get into the nitty-gritty. Something we published 2 years ago. We have been bullish this entire stock market uptrend, following certain fundamental milestones. One of them were targets. We wanted a break to new PEs. When you have quantitative easing and not rampant inflation, then if the market's going to continue higher and price earnings are going to go higher, then really they should break all previous records, and that's what they're doing. Previously in the 1920s, 1980s, economic growth started flattening out the year before. Didn't stop rising, well, it stopped rising, didn't get negative growth, it just flattened out. At the same time, in the 1980s and the 1920s, everyone was wondering what the heck is going on with inflation. Why haven't we got inflation? Because we're expecting it. They started ramping rates up, and the central bank started tightening, the yields started going higher because everyone was expecting the inflation that didn't occur. Does this sound familiar? The last year? But this is the, if you like, the real surprise. Yields are going higher, stock market doing well, economy expected to go well, and yet the dollar, in all 3 decades, all 3 years, 1929, 1987, and 2018, certainly 2017, the dollar fell. Now, why would the dollar fall in those conditions? Because the underlying confidence in what was going on, in other words, the real money, remember the Paul Tudor Jones money in dollar yen that went in and stayed in for the ride? It doesn't want to be there. You know, it might dip in and out, but they don't want to be in the United States and stay there because they do not believe the asset values can be sustained, not in the longer term. And for us, what we've been waiting for, the biggest indicator of all is dividend yields. In all 3 cases, and I'll show you the chart, I was worried you might not see this. Let me start at the bottom. Inflation. Can you see inflation in all 3 decades? Flattens out. People are expecting it to rise. It doesn't rise. You can see also the price earnings is hitting targets. But in dividend yields, in all 3 cases, it broke the previous low into the crash. And the same thing, you don't need to take a picture, you just go to the website, it'll be there. In all 3 cases, dividend yields, and we were waiting for a break to new lows, below 1.73. And in the last 2 months of 2017, we got it. Even though it's yet to be, it actually might now, with the last quarter's report of earnings, might actually be out now, but we know it's below. Our last condition. Okay, so that's the fundamentals. Sounds cool. Lots of people have stood up here before, I'm sure here or elsewhere, and told you the economy can't take what's going on, and yet stock market's gone 10, 20, 30% higher. We have the same intermarket conditions. We have seen something that anyone who's followed us will know, what we called 2 years ago. One thing that happens in the last leg of any uptrend is the correlations break down. It doesn't have the breadth. You see certain things going wrong. Certain markets should be moving if it's going to continue higher, and it doesn't. You've seen excessive, massive rotation between assets. I showed you the dollar yen chart earlier. The reason simply is because what binds these markets together is their fundamentals. And if the fundamentals don't justify it, the prices, and not all markets, will justify it as well. And you start to see significant spiking. It is almost unique what we're seeing now, to see rising yields, rising stocks, and a falling dollar at the same time. It's only happened twice in financial history, 1929 and 1987, led by dollar yen. And as a consequence, commodities going up at the same time. Now, the really interesting thing, the really worrying and uncanny thing is the same sequence of movement between the asset classes from a timing perspective is very similar. It started with a collapse in the bond market that we saw last year. The same thing happened in the first 5 months of 1987. That's already happened in 2016. Commodities started rallying at the same time. Happened in April 1987. You saw what oil and gold have both done already, and looks set to push. And it was actually the final surge in yields. It was quite surprising because for us, one of the conditions was for the US 10-year to go above 3%. and it's already started that move into what was, in 1987, a very, very similar setup. In other words, the, I should say, stock top. But the dollar's still falling. So we're not in a crash, and the market could go up indefinitely. But what triggered the crash itself, let's assume that it's topped, and it hasn't necessarily, was the dollar. A final sell-off from here in the dollar was the final, if you like, the straw that broke the camel's back. In other words, if you're invested in the US, one of the reasons why people are still trading long in the US is because the price is going up. If the price stops going up, you think, well, maybe, and this dollar starts to fall, you may think your asset, your investment might be at risk. And it was that final drop in the dollar from here that triggered the crash in 1987. And again, you won't be able to see this, but what I've just described to you is the 4 asset classes. Again, this is on the website, and you'll be able to see for yourself the interaction. I don't believe in voodoo. I'm not predeterministic. Life has taught me you work on experience. You don't, I'm not into conspiracy theories, but the evidence here is overwhelming. That's that chart again. Does it look so? How many people think they look similar? Yeah, they do. It doesn't mean it will work, does it? I'll give that an 8 out of 10. Yeah? Is that right? Do you want to see a 10 out of 10?
Yeah.
Yeah? We all like 10 out of 10, don't we? Occasionally a 12 would be nice. Does that look better? Does that look better? Slightly better fit?
Too conservative.
Sorry?
Too conservative.
I didn't hear that.
Too conservative.
Too conservative? Yeah, I wouldn't say that. I stood for Parliament for the Tories twice. That's why I'm here today. Boris couldn't make it, although I have spoken earlier with Boris quite a few times. He's a great character. Okay, let me show you why or what. The Dow Jones, the great thing about this is you have 2 scenarios. Oh, that's great. You mean it could go up, it could go down. Yes. 2 scenarios. The price action into the very top is identical to the preceding top. The price action after the preceding top is a flat bottom triangle. Come on, is that similar? Yeah, they're almost identical, aren't they? The problem we had up to this point was the lack, you may not think it because it looks pretty similar, is the lack of definition. One of the reasons for the lack of definition, something I haven't mentioned, is VIX. Yeah, with a bull market and people selling volatility, what it does, it stops the market moving 2 ways as much, so you lose the definition. But what it's saying is, until this point, we haven't had this 10% drop. We haven't had the definition. So maybe VIX has really put us up there and we won't get the definition. Maybe it will. Both lasted 38 to 40 days. We're in a 38 to 40 day consolidation period, whatever it's going to do, and then it'll leave it. You've already seen 20. That was the pattern into the top, the prior top, the preceding top, not the very top. Does that look similar? A rising wedge. This is the Dow Jones that followed on an hourly basis into the top before the 13% drop. It's very, very similar price action. And that's what we've done since. What this is basically is a massive, probably the biggest inflection point you'll ever see. What it's saying is the market at the very top in 1987 and the preceding correction before a massive 23% blowout lasting 67 days was identical. All right, so what do you do, Ed? Well, there's a very clear way of trading it and a very clear strategy that I haven't got time, unfortunately, today to explain, but what we're putting into practice is saying the market is approaching a top that sells off, back into the lows. Then, if it's got one more high, 23% rally, and then 67 days, it will hold that low and go through the roof. Or, if it breaks that low, we have a very different story. We have a 40-day decline worth 38%. That's the crash. And that's how close we could be, either way. Okay, so the biggest tell, the hardest tell of all is the market positioned for a crash? But there are quite a few bears out there now since it dropped 13.6%. Or are people actually saying, well, this is just buy the BTFD, let's buy the dip because it's still an uptrend? A bit of both. Certainly when before we dropped, we had reached extreme historic levels. Funny that, the same as 1987 in bullish sentiment indicators, exactly the same. What's more, you had the same reflection. VIX, again, is that hidden element that you didn't see in 1987 because they did have options back then, but they didn't have 1 month implied volatility. VIX could be playing a different game, but certainly the conditions were the same. Are they the same now? Are they the same now? Good question. After it fallen, because sentiment is so key here, so important, after it fallen we conducted a poll on Twitter. I don't know if any of how many people are here on Twitter? And you can follow me, if you like cartoons and a bad sense of humour, you can follow me. We asked the question, what are you expecting from here? And it was pretty evenly split. I don't know if you can see it, 31% long, 35, only 17% short, 35% looking to sell it higher. That's balanced. It's not what you'd really expect. That sentiment reading is more consistent with a range trade, an inflection point, than any particular direction either way. You would expect if it's going to crash, you would think they might be long. But in fact, it's actually not necessarily saying that. In fact, it could go down and they will be long. So, are we heading for an earthquake or a crash? Dollar yen, do you remember that chart? You remember why dollar yen was diverging? In 1987, dollar yen did exactly the same thing. Paul Tudor Jones, we showed earlier, made his name and fortune in 1987, said, you think you're in the business of trading, but in fact you're actually in the business of decision making. And the sooner you can make your decisions before something happens, the more profitable you will be. Jesse Livermore. Paul Tudor Jones, I'm a fan of Paul Tudor Jones, and I do have Paul Tudor Jones clients. Is a great fan of Jesse Livermore. Jesse Livermore made his name and fortune in 1929 as well. He said, I looked ahead, he had a clear-cut plan, which is why he'd learned to trade intelligently, he was out of the gambler class, he'd learned to trade in a successful, very big way. It was the day of days for him. Ladies and gentlemen, I think we are approaching the day of days. As to when it happens, we have a clear idea. It's going to be in the next 3 to 6 months. We have a strategy that will help us make money either way, whether it is within the next 3 weeks, or more likely, if I'm honest, in 5 months' time. Either way, we're looking for the day of days. Any questions?
There's a really eminent technical analyst called Gann, and he did some time analysis, and he basically says there's a cyclical comparison between what you were saying, the time chart, time cycle analysis, and he was very similar to your approach. Well, he's confirming what you're basically saying.
When I said it's innovative, we are innovative because we're applying it on an intraday, daily, big picture basis that markets have a habit of repeating themselves in similar conditions. We track things. We don't necessarily trade it until it shows the probability is high enough, probability as we can get, and that's evidence-based analysis. And then from there, what we try to implement, it's not something I've gone into, is evidence-based trading. How you can use that probability, whether it's Gann or any other technique, and implement that for successful trading strategy. We've been successful. We've caught some good trends in the right way, but we trade from the next 8 hours intraday scalping to the next 3 months. As I said, been riding this stock market. We set, when the S&P was 1800, we set a target of 25.15. That's a 30% move. We expected the S&P to rise 12% without the 5% correction, and that happened, but it also went 20% because it's the nature of this market. Fighting an uptrend is not the way to make money unless you have the probability, unless you have the same drivers. It's about skewing the probability, skewing the odds, skewing the risk return in your favor. And when you can do that, because you have so much probability pointing to one thing, then you get the day of days. Taking a flyer because it looks toppish is not the way to trade. Selling a market that's dropped 10, 15% already isn't necessarily the way to trade unless it's done it already, which it has. Any other questions? Well, thank you for bearing with me. I'm really, as I explained before, I've been involved in markets for 30 years. I've never seen such a coincidence of different factors. And there is, I started by saying there's, you'll hear a lot of people stand in front of you and give you very compelling arguments. But in each and every case here today, what I try to do is show you the evidence. So you can go away and check out the website and see the evidence in this instance is compelling. In the 30 years I've been trading, I've never seen such a confluence of different factors all pointing to the same story. Be prepared, do your homework, and good luck. Thank you.
So how did you like this presentation, guys? Could it do round of applause again? No? Cool. So we're gonna have a quick break now. We're slightly overrun the time, so the next presentation will be at 12 exactly. So there are some biscuits and a drink just outside. So if you want some drink, please serve yourself, okay? of the day, and followed up by quick Q&A session with presenters. So please give a warm welcome to Mr. Steve Ward.
Afternoon, it's good to be here. Nice sunny day. It was a great view. It's not quite as great now, but probably better for seeing the screens, I guess. So, quick intro. I haven't got long, so I'll whiz through this. But my name is Steve Ward. I spent about 25 years working in the area of peak performance, performance psychology, initially with sports teams and athletes, 33 sports all over the world. 2005, I was asked to come and use sports psychology with a group of traders in London, 150 traders. I'd never really been involved in trading before. They'd never really had any sort of sports psychology before, so it was new for both of us. They really enjoyed it, very beneficial. I thoroughly enjoyed it. And then really from 2006, after the Winter Olympics in Torino, spent more and more time working in the market. So really since 2006, I now spend all my time working with people in trading and investing, hedge funds, banks, investment firms, energy companies, commodities trading companies, securities companies, all over the world, new traders through to guys trading 20, 25, 30 years plus, and did a bit of work in poker, in professional poker for poker stars. And in all those roles, really, what I'm doing is looking at that, I guess, the mindset, how we think about what we're doing. In any activity, whether it be trading, whether it be poker, whether it be sport, no matter what it is, there's going to be a set of skills that people need to be good at what they do. But to do what you do well consistently, and particularly if there's any stress or pressure or high demand, then the mindset becomes increasingly more important. And my role really is helping people to kind of have the right mindset, to think about things in the right way, to manage the stresses, the pressures, to cope with things when they don't go to plan, which happens a lot in trading. That's one of the big challenges. You could even do all the right things in trading and still you lose money. That's quite difficult to deal with sometimes. So my role really is to help people on that side of things. So I've been doing that in trading now for, I guess, almost 13 years. Thoroughly enjoy it. I'd love to have more time. I've got an hour. I could do a week easily, probably 2 if I was ever given the chance. So I'm going to try and run through pretty quickly quite a lot of ideas, throw a lot at you. We'll try and save questions maybe to the end so we can kind of get through the main content. I think that's probably be the best plan, unless it's urgent. But at the end, feel free to ask questions. Also in the panel, I'll hang around at the end as well. So if you've got questions at the end as such, feel free to ask questions then. And if anything crops up beyond today, you can get in touch with the website, ping me a question, say you were here, ask the question, and obviously I'll get back to you via email. So we're going to focus today particularly on mindset. I think it's one of the key factors. We've all got a mindset, whether we know it or not, and some of that mindset will be very helpful for you, but some of your mindset may not be as helpful. The one thing we know about trading and about good traders, successful long-term traders, is their mindset is different to most people. I've met thousands of traders all over the world, and the one thing the best traders have got in common is they are abnormal. They are not like normal people. They don't think like normal people. They don't trade like normal people. If they did, they would not be at the top of the trading tree. They'd be at the bottom. So some of you will have heard of a guy called Mark Douglas. I guess one of sort of the early trading psychology guys. Very sadly passed away last year. He wrote a couple of good books, Trading in the Zone and The Disciplined Trader. If you've not read those, definitely this should be essential reading. And he had this great quote where he said, "The best traders think differently to the rest." And that is absolutely true. And what I'll try and do today is we'll take some key themes in trading and we'll look at what I would call conventional thinking, most people, unhelpful in trading, and then how we need to shift our thinking to give ourselves more chance of becoming profitable. Okay? And we'll get through as much of that as we can. A little bit of interactivity as we go through, some exercises, some questions to think about as well. Join in as much as you are comfortable doing. And yeah, enjoy. Be open-minded, keep thinking to yourself, could this be useful for me in what I do? If it could, great, take it away. If it's not for you, park it to one side. So, let's start with a little bit of video. Documentary called Flawed. Anybody seen this? Okay, not many. Okay, if you've not seen it, it's an interesting video. You can get it on YouTube. It's a documentary. It's about the closing down of the trading pits in Chicago, and it follows some of the traders and the transition and challenges of going off from being a pit trader to trading electronically on the screen. We're going to watch just a very short bit, probably a minute, minute and a half, following one guy who goes to meet his friend. So we've got two people in the same situation. Trading pits are closing down. What we'll see is two very different reactions and responses to the same situation. Two different mindsets. Just bear with me for one moment while I just get the video teed up in the right place.
Did the markets change dramatically?
This is our guy here.
They coming with, my life is over. Well, the guy that's coming in, my life is over. We're gonna have a lot more work to do on the front end to get him into a transitional job.
Okay, so here's our guy. Kenny Ford is his real name. Trading in the pits for about 30 years. Gets the news, it's going obviously on to electronics. You'll see he's not taking it too well. It'd be pretty obvious. Just be thinking and listening out for, if you watch the video, try and get into his mind. What's his mindset? Here's an event that's happening, but how is he thinking about the event? Because this is the key thing about our mindset, is we're all having an experience right now. I'm saying the same thing to all of you, but your experience of what I'm saying is different based on your mindset. How are you filtering that? What's important for you could be different to somebody else. Yeah? And it's a big filtering system, but then the emotions and behaviors that we then have as a result of that are down to the mindset. It's the middleman between the experience and our emotions and behaviors around the experience. So we'll try and get in his mind, and we'll have a little bit of interaction at the end. Okay, here we go.
I have a friend that says, "Nah, I'm gonna go up to his office. He's gonna teach me how to trade screws. They've got a program. In blue when you want to buy and red when you want to sell." Great. When I was growing up, everything was family. Everything. We had summer vacations for 3 weeks. We'd drive from one AAA motel to the next, and we saw everything. Families nowadays, it's hard raising a kid. If they grow up too fast, they're never kids. They're on this computer, they're in this video world, and the family unit is gone. It goes fast, and it's very sad. And I can allude that to Open Outcry. We lose Open Outcry, we've lost an institution.
Oh, did you ever think you'd see that on its own?
Very nice, very nice. This is my little new world. It's a beautiful world, but it's a computer world. Do you enjoy computer life?
I'll tell you what, I have never been happier.
I hate email. I hate computers.
I don't really know how to respond to that.
I believe Open Outcry is the most honorable and the most efficient trade in the world.
It's a new game. It's a new world
It's
order.
a crappy game.
Well, I mean, if you were making a fortune trading electronically, it wouldn't be a crappy game.
I wouldn't enjoy it.
There's a misconception that the local trader can no longer compete with the black boxes or the algorithm guys.
I can't.
First of all, they got to be right to market too.
I've traded for 30 years, and I know markets.
It's a different feel, okay? So it's
Not a field. It's not.
Let me propose this analogy. You're a musician, but you're trained in classical music. All of a sudden, does that mean you can't play jazz? It's arrhythmic, it's atonal? Sure you could. You prefer the classical music or whatever it is. The market is like a symphony. And as a musician, you have to be able to play the music that the conductor gives to you. And that's, I think, what the world has evolved to. Every market is volume is dominated by computers.
Not cattle and not hogs.
I stand corrected, you're right. But that's only a matter of time. But they have the
There's more and it gets better, more interesting. But I think we can see already some insights into his thinking. Anybody willing to offer a few ideas about his mindset and what might be unhelpful in his mindset?
That he can't really adapt to change.
Okay.
It's all still there, but it's just changed from open outcry to a computer system. It's still exactly the same.
Great.
But we just can't adapt to change.
So at the behavior level, he's not adapting. But what in his mindset is stopping him from adapting?
It's a fixed mindset.
Good. So there's
It's a growing mindset. He's
Great.
just closed up.
Great. So it's good. So he's closed. He's not maybe open to the idea of change. And what did we hear in the mindset that might be unhelpful for him in this situation.
Fear of losing.
Yes, fear of losing in terms of in the electronic world, yeah? I can't compete, I'll be no good at that kind of stuff. Yeah, good. So his belief about will I be able to do the task is really important. Yeah, in all of us, confidence, part of it is do I believe I can do this? Self-efficacy. Yeah. And also he's been pit trading, very different to electronic trading, different skill set. Yeah. So he might not believe that, that will be a barrier for sure, great.
I think it extends beyond the trading, so the mindset is it goes across because he feels the same about having lost his family.
To what?
To just modern life and computers.
Good. Early on when he's walking into the building, in his life, because a mindset isn't, we've got a trading mindset, we've got the broader mindset. They all interconnect. His family life, when he was younger, was going around in a car with his family, motel to motel, that was it. Now, he would like that for his own family, but he doesn't get that because his kids are looked into the computer all the time. So the computer has disrupted, in his world, in an unhelpful way, the family unit. So imagine if you've got that as your mindset, and that's your experience, and now you go into work to find out that your trading, your community, your family at work is now being disrupted by the computer. If you think computers are evil and unhelpful and the worst thing ever invented, and then someone tells you your new job is going to be on a computer, your reaction is going to be quite strong and possibly unhelpful if we need to adapt to work on the computer. The event itself is just the event. It's his perception and his beliefs about that event and what it means for him that generate the behavior and the emotion. And that's true for all of us in the world and in our trading experiences. When you have a trading emotion or behavior in relation to an event, your mindset, whether you know it or not and like it or not, has played a factor. And it's doing that consistently from moment to moment. And that mindset has evolved from the moment you were born all the way through life and all the way through your trading experience. And it continues to evolve based on the beliefs and perceptions that you develop and then become the filters for your experience. So again, we haven't got time to go into depth, but a few things to be thinking about beyond today, we can think about mindset, is how you think about risk is going to have a big factor on your trading. How you think about uncertainty, and we'll look at those two in detail a bit later. Your beliefs about losses and what a loss means will be important. Likewise, mistakes. Yeah, Ray Dalio of Bridgewater's got some great stuff out on LinkedIn at the moment, but his book, Principles, which is worth reading if you've not read it, he talks a lot about the importance of making mistakes. If you're not making mistakes, you will not be learning as much as you can learn. It's as simple as that. Or you'll not be stretching yourself to be as good as you can be. Mistakes are a perfectly normal part of the learning experience. Okay. Your beliefs about money and how much money you believe you deserve to make on a trade, from a trading month, from a trading year, will be very important. How much money do you believe you deserve to make in the course of a year, based on maybe what your parents make or what you feel is appropriate within your friendship groups, can be a factor. Your beliefs about success and what success means and what that will do to you. Because bizarrely, you can have people who actually self-sabotage because they're afraid to be too successful, because they're worried about the negative impact that might have on how they perceive themselves or perceived by others. So all this is going on internally. And a good exercise to do for yourself, and there's two ways you can do it, I'll explain very quickly. The first one is think about each of those as a heading, and then think about how do I feel about risk? How do I feel about uncertainty? How do I feel about myself? Myself as a trader. How would you describe yourself? This is going to give you insights into those beliefs and perceptions. Then you need to make 3 lists. On those lists of beliefs and perceptions, some of them are going to be very helpful. I see myself as a disciplined trader. I see the markets as being full of opportunity. They're going to be quite helpful beliefs. So we want to keep those, we leave them. Some will be neutral, neither positive or negative. You might uncover some that you think, do you know what? If I'm sitting in front of a trading screen, and I had a trader once come to me and said, Steve, it's impossible to make money in these markets. Now, if you're a trader turning up to trade each day and you believe it's impossible to make money in the markets, that's obviously an unhelpful belief. But that was a belief he held, and that drove emotions and behaviors which were unhelpful in achieving what he wanted to achieve. The other way of doing it is if you know you get particular emotions or behaviors in your trading that are unhelpful, you know what the outcome is, think back to when you get them, the event, and then work out, if this event happens and I feel like this, what must I be believing to be true in the middle here to connect the event to that emotion? So like reverse engineering it, basically, yeah? So we can start to dig in and delve as to what they might be. And then for the ones that are now unhelpful, just ask yourself, what would be a more useful belief to have? What could I replace that with? What could I think instead? Because now you're starting to think differently. Yeah, but we need that replacement for it. Okay. Very, very quicker than I would like, but that will give you hopefully some food for thought. But that mindset is key. We're going to talk today about how we can start to think differently around some key themes. The first one I think is really important is, and it's a belief of mine, probably from my background, but I see trading as a performance activity. Much as I did when I was in sport, I saw sport as a performance activity. When I was in poker, I saw poker as a performance activity. I've done work with executives, entrepreneurs. I see all these things really as performance activities. And it's important in terms of how we approach it, and then the results we may or may not get. And because it's a performance activity, for me, there are 4 key areas that we need to think about in terms of how we get good at the game. The first one is, if you want to be a good trader or good at anything, you need the skills and knowledge to be good at what you do. Competence. You will never have confidence in yourself if you do not have the skills and knowledge to do what you need to do. So skills and knowledge must always be our first and foremost goal. Competence. Then what you need also is a strategy. The strategy is then how you use your skills and knowledge in your own particular way, based on your personality and your styles within the market in our situation. Okay. But that won't be enough. But that's what most people focus all their time, effort and money on. Learning skills and knowledge, trying to get strategies. Now if you're a newer trader, that's exactly the right thing to be doing. Because the third factor, state, the psychology, will be less important. As you get more experienced and more successful, the state factor will be the most important. Yeah, so there'll be a shifting over time. Our fourth factor is situational factors. This will be things like the market conditions, where you're trading, how you're trading, geopolitical environment, and so on, outside of our control on the whole. But the first 3, very much under our control. Okay. What you could do for yourself, again, very quickly, marks out of 10, skills and knowledge. If 10 is where you feel they could be or should be, where are you currently? Likewise for your strategies, likewise for your state, how you manage yourself physically, mentally, and emotionally when you're in the markets. Now, there's probably a lot of emphasis on skills and knowledge and strategy, not enough on state. However, I do meet some people who spend a lot of time reading books on positive thinking, doing lots of psychology training, and they don't do a lot of work on actually learning how to trade. And then they wonder why they're losing money. The problem is you can be brilliant, you can be the most positive person in this room, in the world, but if you don't have the skills and knowledge to actually trade or a good strategy, you're just going to be very happy about being bad at trading. Okay, it's as simple as that. So the mindset on its own is not enough. But once you start to develop the first 2, the mindset becomes very important. Very important, yeah? In that order. Okay? So if you want to do really well at trading, you need to shift towards seeing it like a performance activity. How do people get good in performance activities is really important. How do they think? How do they approach it? Yeah, becomes key. But again, that's a mindset. If I see it as a hobby, that's okay, but the results you get will be a reflection of the fact you're seeing it as a hobby. But if you know that and that's your choice, that's perfectly fine. But if you want to be the best you can be, the shift will need to happen. This is over to you guys now. So imagine we come around, give all of you £1,000. That'll be probably the best XTB workshop ever. But you're given a choice. You can keep that £1,000, or you can take a risk. We'll flip a coin. You can choose heads or tails. Actually, I don't mind. So you can choose heads or tails. If you call correctly, you double your money. If you're incorrect, you lose the original 1,000. This is the question. Obviously, what I'm interested in is who would keep the money? Who would just keep the 1,000? Hands up. Okay. Who would flip the coin? You've got £1,000 in your hand. You can double it or you can lose it. That's your choice. Yeah. Okay. So about 50-50. 50-50. How about this situation? You have to go to the cash point and draw £1,000 out of your own money. Okay. And you have to pay us that £1,000. Okay. Or you can take a risk. Okay. We can flip the coin. Okay. You can either just give us 1,000, that's fine, you just lose the money, or we flip the coin, and then if you call it correctly, you give us nothing, but if you're wrong, you have to give us 2,000. Who hands over the 1,000? Not as many as I would have liked. Who flips a coin? And some of you are doing nothing. It's just in shock about the idea of obviously giving your hard-earned money to somebody. So here's what's interesting. When you ask this question in the street, and this is from behavioural finance, the psychology of decision-making under risk and uncertainty, 84% of people choose option 1 in the top one. Yeah, I'll keep the 1,000. And in the bottom one, 70% will flip the coin. Now, this is interesting for us because what it shows is a trend towards, in the top, when people are in a situation of gain, profit, a disposition towards risk aversion. Hence why many of us find it hard to run our profits. On the flip side, though, when we're losing, we become increasingly happier to take more risk, to prevent ourselves from losing as a disposition. And this is one factor which plays into the psychology of the reason why it's hard for many of us to run our profits, yet we're better at running our losses. There are others we'll look at as well. This is a key factor. It's around risk. And how do we think about risk? And one of the most important things about risk as a mindset is how much risk am I willing to take? Is a key factor. And where does that fit in with my own individual risk tolerance? Now, I see, this is just my observation, I spend probably 95% plus of my year working with institutional traders and 5% with kind of sort of the retail community. But in that 5% community, I see a lot of people who are trading bigger than they probably should be. And the clues are the fact that they feel anxious when they're in their positions, that they can't run their winners, that they run their losses too far, there's lots of stress and worry. All of that for me indicates initially probably trading too big. Simple as that. Because one of the biggest impacts on your emotional experience in trading is how much risk you are taking, and that will be your personal risk, and then combined with the level of market risk. So those two factors generate your financial risk. So when you're trading, and obviously each of you is individual based on experience and risk tolerance, personality and so on, but think about risk as being this inverted U. And at any given time, in any given market, under any given market conditions, we can be somewhere on that curve. Now, if you're on the left-hand side, you're trading smaller, a lot smaller than you're comfortable with. Okay? You won't be getting a lot of stress there, but what you probably will be doing is making decisions that are different to what would be optimal. So you might have a trade that's really small. Because it's small and it's not hurting you too much, you might let it run much longer than you would normally do. But now you're practicing the skill of running a loss. And whatever you practice the most is who you become. That's how the brain wires. You do stuff, the brain wires, and then you do more of it. So if you trade smaller than you're used to, consistently, and then you don't trade those following your strategy because they're only small, yes, you don't have the stress, but you are rewiring your brain with habits that will not be useful when you try and trade back up to your optimal size. On the far right-hand side is where too many people put themselves. Trading too big, fear, anxiety, worry, stress. And here, when we are stressed, think about the brain as being a two-story house. Lower part of the house, the emotional brain, instinctive, intuitive. Top part of the house is our more deliberate, cognitive, thinking, human brain. When we are stressed and fearful and anxious, the lower part of the house takes over, the top part of the house starts to shut down. The top part of the house is where your self-control and discipline, emotional regulation, ability to think clearly and strategically is all housed. So as your stress level increases and emotions increase, the lower brain is taking over, and then the top brain is shutting down. So now you've got big size, and you've got poor discipline. Now, that's not a great place to put yourself into. So the goal, obviously, ideally, is this kind of top part of the curve. Optimal risk-taking. I've just spent 3 days out with a client over in Europe, just got back last night, and probably 4 or 5 traders I spoke to, I had to have the same conversation with them. These professional traders, 2-3 years into their trading careers, stresses, anxieties, worries, and most of them, when we talk through this, have realised they're trading too big. Or they're trying to, when they're increasing their size, making the jump too big. They're comfortable trading here, then they want to get better, so they increase their size, maybe they double it. One guy from 25 to 50 lots on his trading, but 25 is here, 50 is here. 30 might have been a nice size increase. Bit of a stretch, but we're not into the panic zone. So it's really important to think about your risk, not in terms of how big can I trade. That's irrelevant. I could be the biggest. I could go into any trading floor and be the biggest trader. If they gave me the limits, I wouldn't be the most successful trader. So we've got to think optimal risk sizing. What's the optimal? How do we know if our risk is optimal? Or how do you know if it's too big or too small? What would be our clues?
Fear, anxiety.
Could be fear and anxiety, it could be the feeling we have, or on the left-hand side, boredom and disinterest. But it could be our behaviour. If you've got a strategy and you know how you should be behaving when you perform that, if you're not following your strategy, one thing you can change is your risk and then see if your behaviour changes. And for a lot of you, and I know this because I've done it thousands of times with different traders, it does. Always trade, if you're in doubt, trade a bit smaller. I think Warren Buffett said in investing, always trade within your level of comfort. Don't put yourself where it's uncomfortable. It's difficult there. If market volatility increases, we might need to move ourselves back around the curve because the overall risk is now greater. So it's not a fixed point, it's going to be dynamic. Okay. So it's a bit of an intuitive feel. But I say, for those of you who are finding it hard to trade your strategies in a disciplined way, we'll define what that is later, think about your risk taking. Yeah, optimal. Okay. Imagine there are two boxes on the stage. Over here is a box, it's got 100 balls in it, 50 are red, 50 are blue. Over here, we've got a box, also has got 100 balls, they're red, they're blue, we don't know how many red, how many blue. Your job is to pick a colour, red or blue, and then you've got to try and get that colour ball either from that box there or from this box here. You can choose. First of all, who would go for a red ball? 3, 4, maybe. Everyone else is therefore going blue. Maybe because some of you are wearing blue, or the sky is blue, who knows? Who would go for the box over here? 50 red, 50 blue. Who would go for the box here, the unknown quantity? So probably about 2/3 for here, maybe 1/3 for here. Which do you think is the most popular choice if we asked 1,000 people? Why is this one here popular?
50% chance.
We know what it is. Yeah, we know. Here, this could be advantageous for us. There could be loads of our colour ball in here. We just don't know. Humans have what we call ambiguity aversion. We don't like uncertainty. That's why we like the weather forecast. That's why we like market forecasting. We like to know. Calms our nervous system down, keeps the stress response lower. That's why we prefer, even if that one is the worst choice, we know it's the worst choice, and we like the fact we know it's the worst choice. Yeah? But obviously, in the markets are full of uncertainty. So if we're afraid of uncertainty, how are we ever going to have a sustained trading career in an environment which is full of uncertainty? So one of the key things that we have to get good at in trading, and this is what the best traders are very good at, is we have to learn how to tolerate, embrace uncertainty. We can see uncertainty as a threat, as a negative. We can see it as on the other side, flipping it around, opportunity. If everything was certain, there'd be nowhere near as many trading opportunities, or good ones, if any. So a couple of things we can do about uncertainty. The mindset I try and instill in my clients is one of what we call impermanence. Everything is shifting and changing. And there's a great quote from Heraclitus, it's going back a few thousand years, but no man ever steps into the same river twice, i.e., each time a person steps into a river, the river's always changing because of the flow of the water, and each time the person goes back, they're going to be slightly different. When you trade the markets, it's never the same. When you go back and trade, if you're going to trade on Monday, you will not be the same person as you were when you traded on Friday. Because you'll have had some input today from me and some other people, and that will have shifted you slightly. And you'll have experiences outside of this workshop that will shift you slightly. And the markets will be different. Never exactly the same. So everything's constantly changing. We have to embrace that. That is just the way. So if we can have that mindset of that, everything's changing. When you're making money and it's good, it's not going to last forever. So when it ends, just recognise, hey, it's ended. And when you're losing money, that won't necessarily last forever. Everything's constantly changing. At a very practical level, when we're looking at how we deal with uncertainty, for me, preparation is key, what I call planned uncertainty. As part of your preparation and your analysis for the start of the trading period, think about scenarios. What could happen in the markets today? Look at what's coming out. What might that mean? What data is coming out? What events are key? What scenarios are possible, and how would you deal with them if they actually did happen? So start to think about the uncertain things that could happen before they actually happen. Then when they do happen, you've already thought about it and your system will stay calmer. You'll respond much more effectively. And that's a big difference between good quality preparation and just doing the minimum and getting in the markets, because that's what I enjoy doing. So really, you haven't got to have 1,000 scenarios, but we want to have, a fair number of ones that are possible. You won't know all of them, and if you're very inexperienced, you'll have less ideas than if you're more experienced. Yeah. Good technique called the pre-mortem. Some of you may have heard of. If you haven't, it works like this. I'm now here in the present. Let's imagine I'm going to put a trade on. I think to myself, right, I want to see what might go wrong with this trade. But rather than saying to myself now, what could go wrong with the trade, what I do is I imagine going into the future. Let's say it's going to be a swing trade, let's say 3 days. I imagine it's 3 days' time, my trade's gone wrong. I've lost money. I ask myself, what are all the reasons why my trade has gone wrong and I've lost money? Prospective hindsight. I make a list of them. Then when I'm happy, I come back to the present. And now with my list, I can look at, are there any things here I can do now to mitigate the chances of those things happening? That is a very popular technique with most funds, either done individually, and it can also be done if you're in teams or groups, that we can deal with uncertainty. But the key thing is, embrace it, impermanence, because it's true for life, it's true for the markets. Okay, time for a little activity. Everyone just stand yourselves up for a moment. Risk, when it's too big, and uncertainty, when it's too big, have a common challenge, and this is what it is. So what we're going to do is, and again, join in if you want to. If not, you can just stand and observe and enjoy. Is we're going to do a squat. Yeah? So a little squat position, not for too long. But we're going to go into a squatting position, and we're going to hold it for a period of time, and we're just going to be aware of what am I thinking and what's going on in the body. Okay, we're going to hold it together, those who want to join in. If you've got injuries, obviously be careful. If your trousers are very tight, be careful. It's not a competition, there's no prizes. Okay, it's just a little experiment. Okay? Make sure your knees stay behind your toes, keep your back nice and straight if you can. Okay, ready? So if you want to join in, we're going to go into our squatting position. Just going to hold it. Okay, if you go to the gym and you've got all fancy techniques, you can do those if you want to.
How low do you want us to go?
As low as you want to go. It's not the limbo. Okay, so just check in with the body. What am I noticing going on in my body? But then also come back into my mind. What am I focusing on? What am I thinking? We're just going to keep swapping. As and when you're ready, back into the body. What do I notice? Come back up into the head. What am I focused on? Where am I thinking? Okay, just going for a bit longer. Checking back in with the body, come back into the mind, what am I thinking, where am I focused? Last little bit, maybe. Just checking in with the body, checking back in with the mind. Last little bit. Okay, we'll finish in there. Thanks for your participation. Just give yourselves a bit of a stretch if you need it. Grab a seat. Thank you. So, what did we notice in the body? Discomfort. Good. That's what we're looking for. That's the aim. What were we doing up here? What did people do up here? How did you manage the discomfort?
Think about something else.
Okay, who said that? Somewhere over here somewhere? Yeah, someone said about thinking about something. Yeah, okay, good. So think about something different, so we distract ourselves. Anyone have a different strategy?
Just ignore it. Just ignore the pain.
Ignore the pain? Yeah, how did you ignore it?
I'm used to it.
Okay, all right, so you didn't ignore it, you noticed it, and you remind yourself, I'm used to it. Yeah. So you didn't ignore it, you were aware of it.
Yeah.
But then you recognised, but I'm used to it. And that made it slightly easier. Yeah. Okay, great.
No pain, no gain.
Right, again, just tough our way through it.
Yep.
Yeah. If it doesn't kill us, it will make us stronger.
Yep.
Hopefully.
Definitely.
Yeah.
Stop loss, take a sip of water.
Okay. Just think about the squats for now.
Well, probably, yeah, it's getting a bit tough, so we need to reconsider the position.
Okay. What when we're squatting?
Yeah, like I mean, sort of, if you
So you-
squat 1 hour or whatever. 30
Yeah. Okay. So adjusting the physical position. Yeah.
Yeah.
Yeah. Okay. Great.
You was going to come to an end, so you said almost tough it out.
Yep.
Also, I looked at other people and I thought, I can do this.
Okay.
Basically, I can do it.
Great. So there's a bit of if others can do it, I can do it. That's part of our self-efficacy. Have I seen other people being successful? If so, great. I can too.
Temporary. Pain is temporary.
Yep. Yeah. So it won't be that. So it won't be there forever. There is going to be an end. I've only got 30 odd minutes left. No, not 20 minutes. So that's the longest I could have made you do it for. Is about 20 minutes. So there was going to be an end. Yeah. I didn't tell you how long. I didn't say we'd do it for a minute on purpose because I didn't want you to really know how long we do it for. Uncertainty. How do we deal with that? Yeah. Uncomfortable. Okay. So here's one of the key things. This is, I think, one of the main psychological difficulties in trading. When you are losing money, for most of us, there's a point where that becomes uncomfortable. Okay? And the way that if we go back to our squatting, when it's uncomfortable, what can I do to reduce the discomfort? Good, I can stop doing the squat. And then the discomfort goes away. When I'm in a losing trade and it gets uncomfortable, yeah, the discomfort of taking the loss, how do I avoid the discomfort of taking a loss? Yeah, but that's not the question. When I'm losing money, how do I avoid the discomfort of taking a loss?
You can hedge the position.
Could hedge it.
It's different. Put your money somewhere else. Put the money somewhere else.
We could put it somewhere else. Yeah, so we could try and open another
Double
position.
them so we can make.
We could double it. Yeah, we could double it. What do 90% plus of
Break the
people do?
size down. Could you break the size
They
of
could
the
do, but that isn't what most people do.
Close.
They avoid taking the loss.
Hmm.
It's a simple answer. And they might do it in many different ways, by doubling my size or by opening a position somewhere else. Not because it's a good position, but because I'm just trying to cover the loss I'm having over here. That's not a good trading opportunity. I was working with a guy 2 days ago. He's had a tough start to the month, and we were talking through a trade that he made, and he had a profit target, and I said, well, why did you choose that profit target? Oh, because that's how much money I needed to make to cover my losses from earlier this month. That's not a good strategy for a profit target. Then when it went towards his profit target, and then it came back against him, and through the scratch point, and now he's losing money, and he starts to double his position, and I ask, well, why were you doing that? Is that part of your strategy? No, it's because I can't afford to lose the money because I've already lost money.
Can we call that a revenge trade? Because as a
Yeah.
it's a revenge trade.
Yeah.
Because it happened to me, I lost money, and then I opened the position in view to have my money back,
Yeah.
and then in fact I lost again.
Absolutely. And the key thing there is, what's the motivation behind my trade? Is it because this is a good trading opportunity, and I'm now going to try and trade it as well as I can, or is it because I'm trying to get my money back from a previous loss? And this is critical, because again, a losing trade in the past is uncomfortable, and one way we try and deal with that discomfort is to make ourselves feel better by trying to get a winning trade. But now the job of a trader, and I repeat this many times to people, is to find good trading opportunities according to your strategy and to trade it as well as you possibly can. That's all you've got to do. But once it becomes about, and we'll look at this later, once you start trying to do it to make money or to get money back, when you've lost money, it's gone. Reset, press the refresh button on the computer, reset, you're looking for the next good trading opportunity. That's your job. And then you trade it as well as you can, and you repeat that as many times as you do based on your trading time that you've got available. And every time you deviate away from that and try and make money or not lose money, your perception, your mindset is now different. You see the market differently, you feel differently, you behave differently, and your results suffer. That's the kind of the downward spiral without getting too negative. But just going back to this, when people are losing money, it's uncomfortable. We can avoid the loss by not taking the loss. It keeps us comfortable in the short term. But if the trade keeps going against us, eventually the pain is too high, we have to get out. So in the long term, we suffer more. When I'm running my profits and it gets uncomfortable, will it go further? Will it come back? I don't know. Do you know what? I'll take it now. I feel better. I've got a bit of profit on the table. That's okay. But when it keeps going to my profit target, I now feel worse. And a lot of trading behavior, I've lost money, and maybe I don't take a trade, even though it's a good trade, avoids the discomfort of another loss. And so a lot of trading behavior is driven by what we call short-term avoidance. In this moment, I'm avoiding some kind of discomfort, or I'm going for some short-term pleasure, quick profits, at the expense of what might happen in the longer term based on my strategy. And the antidote to that is we have to psychologically be willing and able to tolerate the short-term discomfort in order to get the long-term gains. And that is a big differentiator of profitable traders and those who aren't. And this is a great quote from market wizard William Eckhart. The human tendency to select comfortable choices will lead most to experience worse than random results. There was a study done a few years back, 200 traders in the US, good traders, top traders. One of the key themes was, or the questions was around, how do you deal with the discomfort of trading? And the answers basically were, I'm slightly better at it, but it's still uncomfortable. So holding a winner is still slightly uncomfortable, but they've learned over time to get better at it. Taking losses is still uncomfortable, but they've learned over time to get better at it. But it doesn't feel easy. And that's a key thing. We shouldn't expect it to be easy. It is going to be uncomfortable. But lots of you, when you were doing the squats and it was uncomfortable, you found ways to cope with it. We drew on past experiences. We were able to distract ourselves. Sometimes people focus on their breathing. But we find ways of coping with things only when we're having the discomfort. So every time you avoid something uncomfortable in your trading, you're missing out on the opportunity to learn the skills required to get good at dealing with discomfort in that situation. And that is one of the most important skills you need to get to be good at trading, without doubt. Distress tolerance is its psychological term, but it sounds a bit painful, but that's what it basically is. But it's critical. So when you're in a losing trade and you have to take a loss, it's going to be uncomfortable. It's fine, it's discomfort. Acknowledge it, it's uncomfortable. Don't have to like it, acknowledge it, and then do what you need to do based on being committed to your strategy. And the next time, it will be slightly easier. The next time, slightly easier. Exposure effect. When we do things that are stressful, the system adapts to make them less stressful over time. If we did squats every day, 5 or 10 minutes, they get easier each time. Body adapts to the stress. If you avoid it, you don't adapt. Running a profitable trade, taking a loss, getting back into the market, all these things are uncomfortable. The more you do them, the better you're going to become. So see them not as threats, not as negative discomfort, opportunity to practice the skills of dealing with discomfort. Great, the market's given me a chance to practice the skills of dealing with discomfort by taking this losing trade at my stop loss level, rather than some alternative thoughts that might come in. We must push on just because of time. One of the things that can be uncomfortable is emotions. Tell me some about emotions in trading. Which emotions are unhelpful in trading? Greed?
Fear.
Fear? Panic? Excitement? Any others? Anger? Yeah. Which emotions are useful in trading? Calm. Calm? Good, great. Positive, great.
None. None. None of them.
None. Okay. It's a very common answer. Unfortunately, it's the wrong answer. When you take a trade, okay, do you like to be confident in that trade?
Yeah.
Okay. And what is confidence?
What is confidence?
It's a feeling. It's
Yeah,
an emotion, yeah.
yeah.
So if we never had any emotion, we would never have that confidence to take a trade. Logically, we would know the trade is good, but without the confidence, we wouldn't act on our analysis. Yeah. Fear. I get loads of emails, unfortunately, from people saying, learn to trade without fear. And I delete them immediately. And if you get that email, also delete it immediately. Imagine you're born and you had a choice. You can live a life now without fear, or you can live a life with fear. Who would choose to live their life without fear?
Everybody.
Okay, well, I'll tell you what happened. It'll be a pretty short one. Why do we have fear? Exactly that. Fear is the emotion that tells us there's a potential risk in our environment. and alerts us to that fact and mobilizes energy so we can deal with it. So if we had no fear, our brain would not identify danger, and eventually at some point, that something dangerous would kill you, probably pretty quickly. Now, what does the emotion excitement tell us? Doesn't have to be.
It actually eliminates rational thinking.
When we're excited, why are we excited? Anticipation of what? Something good, an opportunity, something pleasurable. So, when we are going through the world at a very basic level, the two core emotions that are there to guide us are fear, to keep us safe, and excitement to help us to find opportunities. Now, that's risk and reward in trading terms. If you had no emotion, and I hear this from traders, Steve, help me to trade with no emotion. Okay, get down to your hospital, get some brain surgery, have your limbic system removed. That's how you're going to achieve that goal. But then, what we know from the research about emotions in trading, or emotions in general, as opposed to decision making, is if you remove people's emotional brains, they can't actually make decisions. Which colour pair of socks do I wear in the morning? I can have 10 logical reasons why the red one's not the blue one, but there's no energy in the system to take action. Emotions enable action. Emotion, in motion. I get some fear because there's a potential threat. Something in the market happens. I see something, often quickly, unconsciously, before I detect it consciously, and I get that feeling of fear. Potential danger. It mobilizes energy. Now I can ask myself, have I missed something? What could I see? What's happened here? It may be a false alarm. Better safe than sorry. It may not be. Thank goodness I had that feeling and I acted on it. Excitement mobilizes energy. So when you see a good trade setting up, the energy's there so you can act on your analysis. And so if you go back 10, 15 years in time, yes, we'd have all these books, Trade Without Emotion, even humans be without emotion. Yeah? In other words, be a robot, which is how we are going to probably be in 30, 40 years time anyway. So, but that isn't what you're going to read now, because we know more now about the brain. And whenever you having an experience, the first part of the experience is an emotional experience, because all information comes into the emotional brain first, then it goes up to the cortex, to the cognitive thinking brain. When you watch an advert on TV, you get a feel about the product, then you decide whether I buy it or not. When you meet a person, you get a first impression, then you decide, do I like them or not? But the feeling happens first. So every decision you are having, you've already had a feeling first, whether you like it or not. That's how your brain works. So none of you, hopefully, will be in a situation where you're trading without emotion, because it will mean you'll have to have some brain damage, because that's the only way that system gets short-circuited. But why do we have emotions? We have them because they are data, it's information. When I'm frustrated, it's the emotion that tells me I didn't achieve what I wanted to achieve, and it mobilizes energy so I can do something about it. When I get angry, it's because I've broken one of my rules, or somebody else broke one of my rules, and I've got energy to deal with it. When I'm confident, it's a mobilization of energy so I can act on something that I want to take action on. I was working with a trader not far from here, actually, 2 years ago. Good trader, started trading some new markets, and we were doing some coaching together. And one thing he told me was, I'm getting lots of anxiety in my trading. Not unusual, but more than normal. So I was like, okay, great. Let's keep a track of that, which we did do. And we met again about 4 weeks later, and he said, it's been interesting, Steve, because I've looked, and definitely anxiety is like quite a strong feeling. I said, great. He said, so I asked myself why. Good question. Data. Here's some information. And he said what he realized was, in his new markets he was trading, he was taking risk that was equivalent to his older markets, even though his confidence levels were lower. He didn't know the markets as well, so the movements were more erratic, and that was unsettling him. Didn't trust himself or trust the markets, and he wasn't confident in his strategies. So as a result of that, basically, he reduced his risk, he changed his strategies in those new markets, got some extra coaching and training from people in the bank where he was working who knew those markets better, improved his skills and knowledge, reduced his risk-taking, changed his strategy. Suddenly, his experience is different. Starts trading the markets well, but only because he asked himself, what's the anxiety telling me? What's the message behind the emotion? If we're getting a strong emotion or a consistent emotion, it's telling us something. Emotions are data. That's why we have them. And if we're emotionally intelligent as traders, then we can utilize that to our advantage. So in the new world, a few key things. This is kind of, again, let's call it emotions 2.0. First of all, we need to know if we're even having an emotion, which only about a third of us are good at in real time. It's a trainable skill. A very simple technique for working with emotions, naming and taming. Notice the emotion you're having at the time, label it, give it a name. I'm feeling stressed, I'm feeling anxious, I'm feeling some fear. Okay. As you name the emotion that you're having in the brain, because it's like a messenger, this message received, the brain quietens down. Yeah, Matt Lieberman, UCLA, neuroscientist, naming and taming. If you did nothing else, that's a great technique. I'm about to put a trade on, I notice some anxiety, notice the feeling, I'm feeling anxious, we get a bit of naming and taming, now it's easier to work with that feeling we've got. Data, if it's anxiety, if it's fear, what could that be telling me? Could there be a message here? If so, great. Can I act on it? And that's our third part, is action. Most of the stress-based emotions, anxiety, fear, frustration, they're mobilizing energy. So we can take action, which is good. What's the most effective action to take with the emotion that's present right now? How can I harness it and use it? Is really powerful. And that is the modern world of emotions. When you get a difficult emotion, if you do nothing else but just to recognize you're having that emotion, name it, and you'll get some taming effect. If you want to go a stage further, what's it telling me? Stage further, and what do I choose to do now in the interest of my strategy and my trading goals? It's a really good process to work through. I used to teach, emotional control techniques many, many years ago, and the people who had those techniques are still having to use them because it's just like an ongoing battle. This is about working with the emotion, much more brain friendly, much more effective, much less tiring as well. Okay. We talked a bit about you were saying about revenge trading. I gave a story about a guy who's focused too much on his process. For me, all of you will trade better the less you worry about how much money you're making or losing, and the more you worry about how good are my trading decisions. The process. How good was my preparation, research, analysis? How good was my entries to my trade? How good was my trade management once I was in that position? How good was my exit? How well did I manage my thoughts and my emotions during the trading experience? The better you get at that, the more money you'll make. The more you worry about your money, the more stress and anxiety you'll get, the worse your decisions will be, and the less money you'll make. And I've had traders who I've coached who literally have had heart disorders. I've had eye twitches, all sorts of stress-induced physical conditions because they've become so anxious and worried about the results of their trades. And in 95% of those cases, the cure was just shifting focus back onto the quality of their trading. How well am I trading versus how much money am I making in my trading? Being really curious about the process. The markets are uncertain, the markets are changing and evolving. The one thing you've got control over is the quality of your trading process. That's our controllable. So that's where we want to put all our time. And of course, it won't be fixed. It's going to evolve over time as markets evolve. But the more we focus on that, the better you're going to do over time. Discipline. Someone tell me about what trading discipline means in your own words. Anyone willing to kind of share a definition of discipline? Or anything you've read somewhere? Yep. Okay, great. Rules. Who likes rules? Okay, not many of you. How many of you have got trading rules? Okay, so some of you don't like rules, but you've given yourself trading rules. It's an interesting conflict, isn't it, already?
The rules is set by myself, so I have to like it.
Oh, you have to like it. Okay, good. So we can make ourselves like it, or maybe we can't. So discipline is often have a strategy, have a plan, follow the plan. Yeah? That's kind of what I would say is discipline 1.0, and it's a good starting point for newer traders. Absolutely. As you get more experience, you will not maximize your returns from the market if you follow that same rule. Because if I'm trading in a longer term trade, maybe over a few days, a few weeks, things are going to happen potentially in the market after I've entered the trade that I did not anticipate happening, and might now lead me to want to change my plan. So if I'm too rigid and just stick to the plan, even though the conditions have changed, I'm not going to optimize my returns. If I'm a football coach and we've got a game plan based on our research, but then in the game we realise the plan isn't working, in discipline 1.0, I will stick to the plan, lose the game, but say it's all right, folks, because we stuck to the plan. Or we would adjust the plan to the changing environment to maximise our chances of winning. And that's what the most skilled traders are doing. Yeah. So it's having that bit of flexibility. Sticking to the plan when it's the right thing to do, flexing when that's the right thing to do. And that's what we call situational awareness. What's the environment, what's going on around me and within me, and then being flexible to that. Okay? And that's what I think discipline is. It's not about just rigidly sticking to a plan, but that's a good starting point if you're in those early years of trading for sure. Yeah. Let's do an activity. Here's how it works. We'll use this screen over here. We'll use this screen over here. I'm going to point to a word. We're going to say the word. So this will be obviously red, blue, red, yellow, green. We'll do a few lines all together. 3, 2, 1, go.
Red, green, red, yellow, green, red, green, yellow, green, blue, green, yellow, red, blue, yellow, yellow, blue, red, blue, red, yellow, green.
Okay, you guys pretty good at that? So now what we're going to do is now I'm going to say the colour. So now it'll be blue, green, red, blue, yellow. Okay, 3, 2, 1, go.
Blue, green, red, blue, yellow, yellow, red, green,
Okay, you guys are not quite as good at the second one as the first one. What was happening there? Why was the second one not quite as good as the first one?
Because you see the color and you get
Yeah,
it's a different.
it's different. Good processing time. And the fact we have to stop ourselves from doing something which is instinctive. So most of us will see RED and our first instinct is red. Okay? And you can't not have that first instinct based on obviously our conditioning and what we've learned so far. So when we have to just say the word, that's easy. I see it and I say it, job done, I'm brilliant, excellent, good. And I can do it many times. But when I've got to say the colour, I still get the urge to say the word. I have to stop myself from doing that. It's called inhibition. So I have to stop myself, and then I now have to say the colour. So now I've got a 3-part process. Now this is one of the simplest ways that I can explain what trading discipline is all about, because lots of time, for most people, when we're trading the markets, we will have an urge or an impulse to do something, and often that will not be the most useful response in that situation. So discipline is about, am I able to notice that urge? And if I am, and if I can't notice it, then the next 2 points are irrelevant. You're just going to do the behaviour, and it's bad news. If I can notice it, I need to be able to stop myself, and then need to be able to do something different. Now, that is what I call, that is a key part of our situational awareness, the inner part of my awareness. Noticing a thought, which might lead me to a behaviour, which is unhelpful, stopping myself, doing something different, having an emotion, which might drive a particular behaviour, which may be unhelpful right now, noticing and doing something different. Okay? And that's the process. Now, interestingly, that skill is trainable. Okay? There's many different ways. The approach I generally use for people would be things like mindfulness type-based techniques, which I teach a lot of, where, how we do it for time? Where we would, for example, focus on our breathing. So we take a minute or so, we focus on our breathing, noticing how we're breathing, so we bring our attention to the present moment, what's happening right now. Our mind would also get distracted at some point, we refocus back onto breathing. Okay. Now, it sounds quite a simple technique, but what we're beginning to do is start to learn how to monitor our internal state, recognizing when we're shifting away from our focus and being able to refocus ourselves back in. That activity, that kind of 3-way process, trains what's called the prefrontal cortex here, like the observer in the brain, and that's a key part of trading discipline, is this observer, noticing as we're having it. Journaling is useful, but you get awareness after the event. I made a mistake today, I write down my mistake, tomorrow I might make the same mistake or not. But if I can start to notice what's happening in real time, and then stop myself, and then do something different, that's the skill we need. That for me is real-time, present moment awareness, and that's the key for many people around trading discipline. And I say mindfulness, meditation techniques are very good for that, because they're teaching us to maintain this awareness in real time, but also focusing our attention up here, building the circuits in the brain, the frontal lobes, which also, out of interest, manage the emotional responses we have and manage our stress responses, and also are key to our discipline and to our self-control. They're all frontal lobe functions. And those sorts of practices develop our frontal lobe muscles. Awareness and flexibility are attentional skills. When we do attentional training, that's what we develop. Yeah. So that's definitely something, if you're not doing it, to think about, working on the mind fitness, as we would call it. Here's a question for you, and I think we're almost pretty much there. Yeah. So, final question to think about. So, this is a study that was done a few years back, done in Israel, and they were looking at parole board decision making. So, prisoners obviously in prison, and they get to about 2/3 of the way through the sentence. They come in front of the parole board, and then we have to make a decision: do we let the people out early, or do we keep them in prison? That's kind of the basics. On any given day, we see 20 to 40 people. It's kind of quite a typical caseload. We get the case notes. We can obviously speak to the prisoner. Then we decide, yep, you're out early, or no, you're staying in. Now, on one of the days, this was a selection of 3 people who came into the parole board. Out of those 3, only 1 was released. Who do we think was released and why? Is the question. Anyone willing to offer?
Case 1, because
okay.
They weren't hungry from the mid-afternoon, in the middle of the afternoon.
So they were hungry in the mid-afternoon, but not early on. Yeah, so hunger, okay. Anyone got a different answer or a different reason?
Case 2, because by 1 they'll see what else is to come,
okay.
And then they want to get away from their I think because then there's a little before and the last.
Okay. Great. So a bit of exhaustion. There's a bit of kind of getting a feel for the kind of the cases coming through. Yeah, bit of information. Yeah, more comparison. Yeah, great. Good rationale. Any other thoughts? Case 2. Yeah. Yeah. So could be a cultural bias. Yeah, great. Great. Could be cultural bias in number 2.
Case 3.
Who said 3?
Yeah.
Tell me more about 3.
I want to leave early.
Great. Yeah, towards the end of the day, again, a bit tired, let's just go. So we have to think about which decision is the hardest to make. Is it harder to keep somebody in, and think about kind of sort of how much time we would think about, or is it harder to let someone out? Which would we give the most thought to? Yeah, letting someone out. Yeah. So what they noticed was when the parole board met, the decision to keep people in took a lot less time than the decision to let people out. So it took more mental fuel. When you're using the higher part of the brain, it's very energy hungry. The brain's 2% of your body weight, 25% of energy consumption. Most energy hungry when we're working in the top story, thinking, planning, strategizing, self-control, willpower, emotional regulation, stress regulation, etc., etc., etc. Decision making being key. So every time we make a decision to let somebody out, we're using up some of our brain fuel, glucose, so the brain fuel level goes down. We let another person out, it goes down, that person goes out, the level goes down. Yeah? And this is what happens. If you came to the parole board at the start of the day, you had a 70% chance of being let out, irrespective of your crime, your culture, the sentence length. Pretty good odds. But if you came just before the morning break, you're now down to 20% chance. And what happens, basically, and we see the pattern repeated, and basically what's happening is, as they're letting people out, glucose levels are declining in the brain, so brain energy is getting lower. So the ability to think hard about things is being reduced. In trading terms, also, our self-control, our willpower, our discipline is being reduced. The ability to hold ourselves back is reduced. It's easier just to go with the easy thing, which is the impulse or the urge in trading. In this case, the easy thing is keeping people in. So as they got more tired, and as the brain fuel levels lowered, the brain still has to make decisions, but it starts to make the easiest, simplest decisions. So it gets the job done, it just doesn't do the best job possible, but it can't do because it hasn't got the energy available. Now think about yourselves, because when you are trading, some of you might be trading later in the day, you might have been working all day, and some of you might have quite demanding jobs mentally. And if you come home mentally exhausted and then you start try and trade the markets, you won't have the required levels of discipline, concentration, and focus to be at your best. Unless you obviously put some action in to make sure you refuel, try and take a bit of a break, get some food into the system, rehydrate, etc. But this is a really key thing, and I use this a lot with my institutional traders, because we see patterns as to when their decision making is better and or worse are not dissimilar to this. There are times in the day when we know they're exhausted, and then the period after that, decision making declines. Unless we start to put in things like rest and recovery breaks, making sure they're staying hydrated, keeping the glucose levels high, and so on. Yeah? But be aware, because you can't be disciplined and focused and make good decisions if the brain is low in fuel. Yeah? You can know what you need to do, and you can have a great strategy, but you just won't be able to actually do what you need to do. Yeah? So often it seems like a bit of a, is it really important? Sleep, exercise, nutrition, recovery? Yes, critical. Makes a big, 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 big difference. So just to finish off, a few key things really. It's about doing things differently, and doing something differently means we've got to think about it differently. Think about trading as a performance activity. Think about your risk, optimal, not biggest. Uncertainty, embrace it, enjoy it, see it as opportunity, plan for it, planned uncertainty. Discomfort. Let's move from being afraid of discomfort to approaching it, tolerating it, growing through it. Emotions, we could see them as being negative, we have to control them, or we can start to work with them, use them as data. We can focus on our profits and our losses, or we can focus instead on our process and making better quality decisions. We can forget that our brain sits inside the body and just hope that it does a good job, or we can recognize the brain sits inside the body and they require energy, and we can manage that by looking after ourselves, health, well-being, food, etc., so we get optimized the brain. Hedge fund traders particularly are massive into optimizing the brain, because the brain of a hedge fund trader, that's like a Ferrari in an F1 race, or a Formula 1 car. If it's not well looked after and maintained, it's costly. Yours is exactly the same. Exactly the same. Makes a big, big difference. Other than that, thanks for paying attention. Thanks for joining in with the squats and stuff. Good luck with all the trading. I say, if you've got any questions, are we doing a little panel thing now? Yes, we're going to do some questions now. I'll hang around after the panel if you've got some questions then as well. Feel free. Otherwise, feel free to email if you've got questions in the future. Thank you very much.
Thank you very much. So we're going to start Q&A session in about a minute. Actually, we had a couple of clients who couldn't make it today, but they sent a couple of questions ahead. So if you don't mind, we're going to go through that as well. Just to keep it started going. Cheers. Okay. So the first question we had is for you, Steve. And it was, I have a massive trouble convincing myself to sell the markets. It's a problem with the way I think. I'm more keen to buy. What should I do to correct this?
Okay. Very difficult to obviously give individual advice, because we could have 50 people with the same problem, but the reasons why could be completely different. But one thing that's interesting is if you started trading in a bull market, you will find it much easier to buy and a lot harder to sell. And if you started trading in a bear market, you'll find it much easier to sell and probably harder to buy. So the conditions that we started trading in have a powerful effect on our biases going forward. So that's one general thing I can offer. At an individual level, there can be many, many different reasons, just in terms of previous success rates. Has the person maybe shorted something early on, had a big loss, so now in the brain, what happens is if we take a big loss when we've sold something, it remembers that. So now we've got an aversion, because again, it's uncomfortable. So that could be a potential thing. So without knowing more about the person, harder. But that's a couple of things that I think just to bear in mind.
Great. The second question was for Ed, and it was, what's your most popular technical indicator?
And
why?
if anyone listens to my presentation, I'll know it'd be using the right instrument at the right time, right indicator. And I thought we were going to all answer the first question. I was going to say exactly the same thing. People are natural bears born in the bear market. My favourite indicator, it's probably the hardest because markets are driven by sentiment ultimately, and decision makers who buy and sell. So if there was a holy grail, it'd be to know what everyone was doing or likely to be confronted with a particular market at a particular time. So the most powerful indicator is a sentiment indicator. The problem is sentiment indicators are so difficult to read, and that people look at any market that's 80% bullish, you assume it goes down because all they can do is sell. But unfortunately, what we've seen in the US stock market or any major bull market, even with Bitcoin's a great example because everyone may be long, but new people coming into the market buying actually leaves the market net short. And those people who are now short because they've been bought off actually want to buy, and so they drive the price up even more. If you could nail sentiment, then you'd nail everything. So the best indicator would be the best sentiment indicator.
And the last question was for David, and it was, do you think Ripple will ever get back to $3? What would be the time frame for that?
Well, just picking up on what you said earlier, and when I was saying I think a lot of people seem to have a difficulty in shorting cryptocurrencies, I think it's because they obviously began trading it in a roaring bull market. So every time they've longed it before, they've made money. Whenever they've gone short, they've probably lost money. So have this strong psychological aversion to going short, which obviously longer term, when you trade for a long period of time, you'll have bull markets, bear markets, and if you can be flexible both sides, that's good. Regarding Ripple, I think it certainly could get back to around 330. For the moment, the way I look at it, the uptrend's in quite serious technical trouble. It's struggling along. It had that huge surge higher. It's pulled back down a lot now below 1. In the coming weeks, I think we'll probably stick around these sort of ranges we've had. But if we do get some positive moves, and especially if we get, as I was saying, that sort of rotation out of Bitcoin into Ripple because it's faster, easier for transactions, then you could see some money coming out of Bitcoin going into Ripple, and that could push it back to 330 something.
Excellent. So now if you have any questions, just raise your hand and my colleague will be shortly with you with microphone. So that was the gentleman first on there, yeah?
Hello. Hi. Thanks for the excellent presentations. This question is for David. David, you mentioned in Ethereum, use the exponential moving average crossover. That's the 8 and the 21. Now, when you take a long trade on retracement, which moving average should the market retrace to before you take a long trade?
Okay, the way I use it, I don't have like a precondition as if it pulls to the 8, I'll take a long, or it pulls to the 21, I'll take a long. I use them simply as a guide of overall, do I want to be long or short this market? So if the 8's above the 21, I'll be looking for long positions. If I'm looking for a retracement, I'll probably rather use Fibonacci's there and use a fib retracement into it or a pullback towards them. But I don't have a specific, if it touches the 8 period EMA, I definitely want to long from there.
No, I think what I was asking.
Oh, sorry.
No, I accept what you said. If you're waiting for the market to come back before you take a long position,
yeah,
and you've just to chase below 8, should you wait until the 21?
Unfortunately, you never know. With hindsight, you can say that's exactly right. You never know. Sometimes you get a shallow retracement, it'll just come down and kiss the 8 and go higher again. Sometimes you might have a deep retracement where it goes through the 8, through the 21, but still in a positive orientation, and then you get a bounce. So you can never know for sure. What I'd look for rather than, so I use the exponential moving averages as a guide rather than an entry signal. So like I say, if they're in that bullish orientation, I'm looking for a long position. I'd then look for something else, some sort of positive candlestick pattern or something like that.
Can I just add a?
Yeah.
We had a Bitcoin analyst, and one thing he was saying is that the mistake a lot of people are using is they're born off this uptrend in crypto, and so they've been heavily reliant on trend indicators, which is obviously moving average or exponential moving average is brilliant for that. And what they don't appreciate is that the market, given the bubble burst, what markets often do, it's a deflationary environment, they often range for a significant period of time. Now, when the market ranges, moving averages will screw you because it'll go forever through your 8 and your 21, give you false signals all the time. And what people should now be looking at, if they're going to do studies on crypto, is actually more things like oscillators and stochastics and RSIs, rather than rely on trending indicators which have worked, look at ranging indicators.
Thanks very much.
What's next? Yeah?
Yeah, okay. Yeah, this is just personal question about myself. What is, when I first started trading, I was only trading stocks. I didn't know anything about currencies. And I used to watch a lot of Bloomberg and news channel and different things. And I find that Bloomberg was the first thing I put on when I trade. And I don't know, for some reason I used to very much interested in the fundamentals. But since I moved on to Forex a few years ago, I don't know if I'm right or not, or I switched off everything. I don't even listen to, if someone said to me to buy this or buy that's a good trade, I just ignore all those sort of stuff and just look at the chart. Because I find that because of my personality, I'm learning to find out what type of personality I've got. If someone says to me to buy, say for instance, the euro because it's going up, I might think, yes, it might be going up, but it's looking as though it's going down to me. And because if I'm a short-term trader, but if I'm a swing trader, then that might be different. But if I'm a sort of integer, then I think, yeah, that could be right. So the information that they give in, confusing because they're saying to me, well, buy this, it's going to go long. And I'm thinking to myself, well, no, because I'm not going to sit in it for 3 or 4 weeks. But on the short term, I'm looking at it. So I'm confused in a way. Should I look at news still? Should I still be listening to this?
Well, I think if you're trading from a short-term perspective, like you say, overriding long-term fundamentals won't have too big an impact. So you can get quite a big pullback, even if the euro-US dollar from fundamental reasons is rallying in the almost year-long uptrend that we've seen recently. If you're looking to trade on Monday, within 8 hours, just buying euro and hoping it goes higher is not the best strategy. So shorter term, you can be a lot more precise with your entries and exits if you use technical analysis, which I think is good, a good tool to utilize. I would also say if you're looking fundamentally to trade, I wouldn't have an overarching long-term view if you're trading on short time frames, but be very aware of fundamental developments that might come out that day. So for instance, on Wednesday, we have a speech from the new Fed Chair, Jerome Powell. If you're going to trade the US dollar pairs, that's very important from a fundamental perspective on Wednesday. But an overarching fundamental view, I don't think for an intraday trader helps that much.
Okay. Can I ask one more question since I've got the microphone?
Yeah, I was just going to add one thing to your point, because it's a good point. Is and too often when you see lots of training academies, they teach you their method of trading rather than something that's suited to you. And the obvious thing is play to your own strengths. Don't try to force yourself into, you have your own lifestyle, you have your own bent and your skill sets, to stick to that. I've had lifelong customers, clients I advise, professional traders, institutional traders who've done very well. One thing I would say, the 2 things that they all have in common is they seek and gain quality advice, but they keep their own counsel. In other words, they'll say, do you think it's going higher? Okay, fine, take it on board. I'm going to do my own thing because my trading style is different to yours. So listen to someone saying, do that. You're already doing it. You've recognized that. I mean, recognition, self-recognition, this is half the solution. So you've already recognized you're trying to cut out the noise. Noise can be useful as an indicator, but recognize its noise.
Yeah, okay, that's great. Thank you very much for that. One last question I was going to ask for Ed. It's since I've got the microphone. You said something about for instance, that the habits of the different currencies.
Yeah.
Because I found that at one point I was doing a lot of just euros because I thought it was a shorter range, and it wasn't too long as in case the GBP. And for some reason I started doing the GBP again, and that just really just done me in.
Yeah, stay away from it.
So I've gone back down to the euro. But what you said I wanted to ask you, you said that there's different habits.
Yeah.
And I'm trying to work out the habits, but where do you go to find out the habits?
By watching.
Well, just watching.
Or if you're lucky enough to have had an overly long career in the city, you see it as you doing in your own trading form. For example, New York could never handle the points on cable, dollar sterling, because the points were too big for them. So they often would spike because they stop out and they can't afford to lose that amount of money. And it's the people who are, each market has its own different type of flow. If you take something like dollar yen traditionally, historically, you have significant importers, exporters. And the way the Japanese importers and exporters would work, they work on bigger figure hedging strategies for the corporations. So dollar yen would like to trade, you know, like 107, 108, 107, 108 before it makes its next move. Whereas cable doesn't have that same influence. The corporations will have a different perspective, or the banks, or whatever is driving that market will determine how it moves. And cable is, particularly in New York, spikes, and euro dollar is its own beast, and everyone piles into euro dollar. So it's actually probably the most normalized because it has the most flows. The fewer the flows, the more vulnerable it is to its own idiosyncrasies.
And you can see that in cryptocurrencies as well. The sort of volatilities and the moves you get there are a lot bigger than traditional pairs, like you say. So, you know, a 50, 60 pip move in euro US dollar is a fairly big move on those days. 50, 60 dollar move in Bitcoin is very minimal. So.
More questions?
I have a lot more, but it's not fair.
Hi there. First, excellent presentations. I've got two questions. One for Ed first. The graph you showed for going back to 87, as far as I can tell, on XTB's platform, we can't access that data. So how would you get that data to do any correlations for like what's happening at the moment?
I'm sure you, if you ask XTB politely, they'll probably be able to dig you out a chart, whatever. What instrument is? Do you remember?
I looked at
stocks
and Euro USD. Yeah,
it's, obviously by nature of what we do, we have an extensive database and we've bought it, so we access it. So it's not some of the stuff we look at. For example, something I didn't talk about is some of the stocks like RCA are following. Some currencies, some markets are actually following the stocks from the 1920s, and you've got to dig really hard to find that data. But there is a large amount of data out there, so I can't, unless I know what it is specifically, I can't help you. But all the charts in my presentation are on the website, so if you want to have a look, go ahead. But
from our point of view, the reason why we don't have the data going back much further than what we do, I think it's normally about 10 years, is there's just so much data on the chart. Because it's running in real time, it becomes slow and clunky. So new data coming on it, it doesn't process it as quickly, it's not as smooth. We do obviously have access to this data, and if you want, if you drop myself an email or speak to your account manager, we could probably try and send you an older version of the chart. We just don't have it live on the platform because it makes it slower.
Right, but is it like a CSV file or something, so we can like actually
copy? To be honest, you're the first person who's ever asked this to me, so I don't know exactly, but I can certainly look into it for you and try and help you out.
Definitely see with the back office.
Yeah, I'm sure we can find something like that. Like Ed says, you can normally find the data, it's just a case of digging and finding it.
And the second question is for Steve. Because you're trading like psychology, would you say there's any strategies which actually help or are compatible with psychology more than others in any time frames?
I think for most people, as a general rule, the shorter the time frame you trade, the more challenging you're going to find it psychologically. And the longer the time frame, the slightly easier you're going to find it. That's a very general rule, but we have to moderate that with the fact that if we look and we have an instrument called the risk type compass, so we can look at people's risk profiles, how they manage uncertainty, decision making, and so on. So we can look at a person's disposition. Now, some people are able to tolerate volatility, short-term moves, the consequences of a losing trade a lot more easily than other people. Some people's information processing speed is much faster than other people's. So there's going to be individual difference for sure, and this is why I use a little triangle. We kind of have the trader, the strategies, and the markets as kind of 3 waypoints. And what you're looking for really is the ideal is we understand the trader and their uniquenesses. We try and match that to strategies, i.e. long-term, short-term spreads, outrights, etc., which then are conducive to their personality and styles, and also then the best markets to express those in. We're looking for that kind of combination. For each person, there may be a niche sweet spot, but it's probably more of a zone that we can kind of flex around. But I would say for the majority of people, as a general rule, psychologically shorter time frame trading, more trades per day, example, is going to be harder because A, the speed of having to make the decision makes it more difficult psychologically. You've got more wins and or losses to deal with, therefore more emotions and stress responses in the system on a daily basis, as opposed to maybe doing something like a swing trade into even an investment where you've got more time to think, consider, plan, everything's moving more slowly. Think about driving in on a quiet, a quiet road with not a lot of traffic versus, whizzing around, London in rush hour, at high speed. It's a very different experience on the nervous system. And most people do better when it's a little bit calmer, more time to think, as opposed to that rushing.
That's great insight. It reminded me of when I started trading at Citibank. I got to know the chief dealer in New York very well, and he told me his daily strategy. He'd walk in and look at the market and say to himself, how can this market get screwed the best and quickest way? And that's his starting premise, and he drove his whole strategy all day. The market will get screwed.
It's a mini kind of pre-mortem, that's it really, effectively. So what could go wrong? Start with that. Or I would even go to the end of the day. Imagine it's the end of the day, the market has been screwed. Why has that happened? Because psychologically, it's called prospective hindsight, much more powerful than thinking from the present forward. Better to imagine being at the point and work out what happened from as if it had. It's a great technique. A guy called Gary Klein, a neuroscientist in the States. Going back to your point very quickly as well, with that match, I see trading and market selection be like dating. Yeah, because we talked about like nuances of the market, understanding the habits. Any of us who've had longer term partners, we know. I know when my wife says yes, sometimes she means no. Yeah, and I know that because I can most of the time, yeah, correct. And I know that because I know her. I know how she thinks. I can read the nuances. Yeah. That's the same with a market. All the markets have got their own little patterns, and you will form a relationship with a market, and sometimes that relationship will work out really well because it's a match, and sometimes we'll trade a market and it just doesn't feel right because it's just not for you, and that's the same with human relationships, and the same with trader-market relationships.
What he's saying is his strategy with his wife wouldn't work for me.
Nothing works with my wife, is what I'm saying, but nothing I've tried so far. But that's what I see is really important because when we spend time with a partner or even our friends, we get to know them well, don't we? But through spending time with them. When we spend time in a market and we spend time trading it over time, we get to know it well. And then and this is the advantage of the guys who are trading 10, 12 hours a day, 60 hours a week, is they are getting the nuances of the market. When you dip in and dip out, you're not.
Yeah.
And that will change.
I've spent 16 hours, up to 18 hours before.
60?
18 hours a day sometimes.
Oh, 18 hours a day?
Yeah. But now I'm spending about 12 to 16, trying to learn what you said, learn the different things,
Might be too much.
It is too much, yeah. I'm not eating either.
Just a quick notice for you guys. We've got about 5 more minutes for questions, but you can speak to us in the lobby if you have any further questions.
Yes. Do you think that is it better to trade at home or better be somewhere else and make your trading? The question is because at home, with your example with your wife, if you are winning and then she's happy, if you are losing,
you are at the door.
Yeah, this is the question. What do you think? What is the preference? I mean, better trade somewhere else or just stay at home and do your trade? Thank you.
I think for me, it's you want an environment where you can perform consistently. So it doesn't matter if you're at home trading like that, or you have an office space, or you're on a prop trading floor. You want to have everything else around you that allows you just to focus on the markets and trade on that. So really, in terms of your execution, your charting, stuff like that, assuming that's all the same, it shouldn't really make a difference if you're at home in the office. If you do trade 2 places, then I'd say compare your performances. If you're seeing every time you trade at home, you have significantly worse performance, possibly something to do with the wife, then don't spend less time trading at home, maybe go to the office. But I'm sure you can.
I'd say it's very, very individual. I mean, what I can say is most people who have traded, I've got bank guys, hedge fund guys, NG guys who've spent 15, 20 years trading in an institution, is quite difficult when they go and try and trade from home. But where people have started at home and then gone maybe to a prop trading floor, to a trading arcade, or maybe got into a fund of some sort, That's often slightly an easier transition for people, but it is very, very depends on the space you've got. You know, it depends on the environment you're in, physical environment, who's in that environment, how much you can, you know, focus and so on. Cost can be a factor, because if you have an office and you've got to be paying rent and fees, now mentally you can be thinking, I've got to make so much money per month to cover my basic costs. Now in a trading group, that could be anywhere between £4,000 and £8,000 a month. So if you're in a prop group, you could have a £4,000 to £8,000 per month starting point to get to break even. If you're at home, obviously that's going to be a lot less. So there's those factors to consider as well. But then in a group, you've got a lot of social factors. And if you're a sociable person and you make yourself trade at home 12 hours a day, that is not sustainable. If you're a sociable, unless you can build socializing into your day. So multiple factors to think about.
Cheers. Thank you. I'd like to just say thank you to Ed, David, and Steve and XTB for putting on this amazing presentation. My first question is to, or my only question is to Stephen, it's about risk acceptance. And he was talking about earlier how traders can only, they should only risk a certain amounts that they're comfortable with, so negative emotions don't impact their trading. So whether that's a percentage or a capital based. My question is, how would you gradually increase percentage of risk, or the amount of risk, while still keeping within that mindset needed to trade profitably?
So I'm sure you guys will have thoughts about, but my view is, when people are going to increase their trading size, take more risk, the first thing I'm interested in is why. So what's the motivation behind trading bigger? If it's because I've had just 1 or 2 winning trades, for me that's not a sufficient motivation. If it's been a sustained period over time,
it's like a checkpoint.
Yeah.
You've got to a checkpoint and
so we need to be ready. Then we've also got to think about, if I'm going to increase my size, how much? So what's the right size increment? What am I comfortable with doing now? What am I willing to go to next? And I would normally get people to kind of mentally rehearse. Let's kind of all go on the simulator. Let's try that out. How does it feel? Does it feel too big? Does it feel just... We want it to be a bit of a stretch, so it's a little bit of a... But we don't want it to be a panic. So if you think comfort zone, stretch zone, panic, we want to be stretching, so we feel we're doing bigger and better. So psychologically we are improving, but we don't want to be panicking and worrying. So that's a good test. We've got to think about, does my account balance give me enough room that I feel comfortable losing? If I had a string of losses, which is probable, possible, can I endure that? Because if I have 1 or 2 losses, but then I reduce my size again, and then I get 1 or 2 winners, I get stuck in that cycle. That's really unhelpful. So once I've kind of committed to going bigger, I need to go bigger for a while so that my outcomes get me those returns. So I need to be able to withdraw. So look at what my natural drawdown period might be. If I had that with my next size up, can I tolerate that? It's really important. Market conditions. What's the risk in the market? If the market's a bit, I'm not quite feeling it, it doesn't seem to be trading right for me, that's not a good time to increase size, because the market risk has increased. We want something, for you, markets you kind of understand, feel comfortable trading, look at the volatility, event risk, and so on. I think they're probably the key things. So just really, I think it's about structuring it a bit more. A lot of people, it's quite a haphazard process, even professionals. It's just done a bit randomly. Had a good week, had a good month, boss says I've got to, feel that I should, saw some increased volatility, felt that I should trade bigger, rather than just having that little bit of maybe deliberation, just to make sure, because then it's about reducing risk. If you go too big, and then that trade loses, it's like a car crash for the brain, it's traumatic. A big losing trade is traumatic in the brain, and when you try and increase your size again, the brain cannot not really help you to remember that the last time you did that, it was painful. And now we're into avoidance. So we're just trying to think about diving boards. If you're good at a 1 meter board, before you get to the 10, maybe try the 3 or the 5. If you go to the 10 and you belly flop, and then you try and go to the 10 again, you cannot stop your brain from telling you, the last time we did this, it really hurt. Let's not do it again. And that becomes difficult now to then increase size over time. So.
One of my mantras is trade from strength. So you're talking about comfort zone. So if you leave your comfort zone and don't feel comfortable, then obviously you're not ready for it. One thing I just naturally do is successful traders are passionate about markets. They trade markets. They don't trade their P&L. I don't look at my P&L ever. I know if I'm down 50 points, I know what that means in terms of money. I'm not watching your ticket. So if anyone is struggling, if you're doing that, you think you're ready to go up 10% size, and you know, recognize what that means, turn off the P&L. Actually, just focus on the market and not the P&L, because if you're going to do the same thing, the market conditions are the same, and you're going to do the same thing. You don't need to be reminded that it's costing you 10% more every time you do that trade.
Yeah, that's very good advice. I think you always want to be trading the market, not trading your P&L. And I think, like,
I'd agree.
Like the chart you showed earlier, where your optimal risk. Well, don't think I've made X amount in terms of money, X amount of pounds. Think I've made X amount of pips or X amount of tips. And therefore, it's a scalable sort of trading solution. And because as you become bigger account, you can risk the same amount of your account size. When you're talking about returns, you're saying earlier 10% a month compounded. If that's 10% a month you're doing, it doesn't matter what your account size is. To make more money, if you take more risk, that's not necessarily the right approach. You want to be at your optimal risk point, and then as your account grows, you can risk a similar amount of your account trading that strategy.
And that curve will shift. Yeah. So as you get more experienced, your curve is basically shifting in that direction. So the optimal point now, let's say it's 10 contracts. Just for example, is your optimal now, and you decide to increase it to 12. Eventually 12 becomes comfortable, so now your optimal is 12, and when you stretch it, it might have to go to 15. So your curve is going to shift. But then if the market gets more volatile, let's say you get to 15s in a volatile market might feel too much. You might have to come back down to the 10. So there's got to be flexibility. I was having a discussion with one of the guys last week, and I used to do a lot of windsurfing. If any of you have windsurfed or sailed, what you know is the size of the sail or the oar has to be adapted to the strength of the wind. Now, when I was windsurfing, you get a few guys, pretty big guys, full of ego, and they're like, no matter what the wind is, I'll do the biggest sail out on the water. That's the goal. Yeah. But they're not the guys who are sailing the fastest or the best. But they'll come back, oh yeah, I was on my 9-meter sail, Steve. Yeah, great. Spent most of the time in the water looking like an idiot. But it's a nice story. I was on my 4.5, whizzing around, hopping over the jumps, having a great time. And I think that's what we've got to do with our sizing. You've got to think sail size based on the conditions. And a lot of people get stuck in I'm a 20-lot trader, I'm a 10-pounder point trader, and it's like this is what I am. It shouldn't be that way. It should be a range of flexibility based on obviously your kind of budget, your bank, your account, but also the market volatility and conditions. And it's factoring all that in, and then like a windsurfer, you make a judgment call based on experience as to what you think the right sale might be, and you might find out it was too big, too small, and then also we have to adjust it a little bit.
So like the situational awareness that you're talking
Exactly
about.
that. Self, others, environment. In our case, the environment obviously is the market. Others might be other traders in our community and so on. So exactly that. Exactly that. Great.
Unfortunately, we don't have much time to continue with the questions, but if you do have any, we will be able to answer them in the lobby. So